Okay, guys, we are back with getting set up for the questions and answers. You can continue to send questions, but do realize again, real quick, that we're not going to be able to get through all of them. I have well over hundreds of emails here in my inbox, but I am getting through a bunch of them. Also, just as a reminder, we will have a replay of this morning's session again this evening at 6 p.m. Eastern Time, New York time. So we will open up the room about 30 minutes beforehand, and we will have the ability for you to watch this today's sessions over at that time. With regard to the questions, these are going to be also, I don't believe Mark is set up for any charts to be able to pull anything up real time. That will be an option that we will have available for the live trading day. That's where Mark will have all of his charts and his trading software all set up properly. Looking good. And so that's another opportunity for questions and answers for that purpose. Again, this is scheduled to go a couple hours. Mark does try to go as long as he can with questions. So I do want to just let you know, even though I wrote on the itinerary, it might have been scheduled for about 2 hours. It certainly is common for Mark to go even past that point if we can try to get through as many as we can. So with that, we will have Mark Ritchie here as well. I do know a few questions were directed to him, but Mark and Mark will both be available. And just going to pause for one moment as we just get our final setup, final preparation. So stand by 1 minute. Let me just see if there's any other questions here right now in the chat room.
Okay, let's just do a quick. Can you hear me, Bob?
Yes, I can. If you can raise your hand, just letting us know that you're hearing Mark.
Because I had to reset my screen here.
And then also,
Okay,
that looks
Mark
great.
Mark Ritchie, are you available?
I am here. Can you guys hear me okay?
Okay, good.
A little loud, Mark Ritchie, just a little loud. But
Okay.
if you can raise your hand to let us know that you are hearing Mark Ritchie.
Okay.
And if the neighbors can hear Mark Ritchie as well, raise your hand again. Okay, that's good.
Hold on 1 second. Let me just. 1 second. Okay, just want to do a few things here. Just adjusting, making a couple adjustments, and we'll get started. Just 1 second. Everybody here, right? Okay. Let's see here. Okay, got that. I think we're set. I think that's everything. All right. So we're going to be able to go back into the workbook, and we'll start recording in just a second, I guess, right? We haven't started recording yet. No. So we'll start recording in just a second. So this can be replayed, of course. So we'll be able to go through the workbook and go back to pages. So hopefully you wrote down questions that you had, and we'll be able to, hold on a second. Whoops. Okay, that's a problem. Hold on a second. Sorry about that. Gotta resize because there was was keeping me from being able to edit on it. Okay. How's that? Does that look fine?
That does.
Okay, so yeah, but that doesn't mean that you have to ask questions just that pertain to the workbook. Although I don't have the ability to bring up charts right now. My screen isn't set up for that. On live trading day, we'll have live charts up, and we'll be able to bring up MarketSmith. We'll bring up regular live charts that you'll see on my trading platform and what I'm looking at throughout the day live. So we'll be able to do that. So save that for live trading day. Right now, anything that you need clarified in the curriculum, that's what this is for mainly. But we'll answer any questions that you want, but try to keep them as specific as you can to examples, maybe that there are slides or some examples, because if we go hypothetical and we start talking about things that might happen or could happen, then it gets a little convoluted. People have a hard time following along. All right, so with that, let's start. You want to start recording? And
Mark, hold on before you do that. If you could go back to that participants panel. Mark isn't showing his video. He needs to be made a co-host, and I'm not seeing that.
You see. Okay, I just made him a co-host.
Okay, now
should be now. Yep.
Let's get him on camera. Oh, there he is.
There we go.
All righty.
Awesome.
All right. So with that said, then let's, you got the recording marker?
Yeah, I could do that. Okay, so we're recording.
Recording in progress.
Okay, so welcome back to the 2022 Master Trader Program. This is day 2 conclusion of the curriculum, and the question and answer session is what we're here for, to have Mark Minervini and Mark Ritchie with us to answer these questions. So with that said, Mark, if you're ready, let's get into it.
Let's go.
First, a quick question on the MarketSmith platform. You referenced the net profit margin. There are 3 options there. The question is, which do you use, gross margins, pre-tax margins, or after-tax margins on the MarketSmith product?
Well, I look at them all, but you can't see them all together on MarketSmith. So you do have to choose which one you want laid over the chart. So you probably want to start off with maybe gross margins or pre-tax margins, after tax or net margins. But I'm looking at them all, but you'll tend to see them sort of go in lockstep. Just the gross margins will obviously be larger. Gross margins or pre-tax margins.
All right. Questions asked of any or all the book recommendations, readings that one should be reading that you can recommend.
Well, I'll give a list of that. I have actually put that on Twitter. I put a list of the books that I would recommend. But to be honest with you, I would really recommend reading my books and maybe O'Neill's books over and over and over. I'd rather have you read my books and O'Neill's book, 10 times each than going out and reading 50 books. So if you read a whole bunch of books, you're going to get different opinions, and you really want to have whatever you're being coached, then you want to, whatever you're bringing in from other coaches, you want it to be homogenous. And O'Neill's work and my work, works together. And then I would recommend Livermore. If you want to have some fun reads, you certainly can read, Reminiscences of the Stock Market Operator and Nicholas Darvis, things like that. But other than that, everything you need is in my books. You don't really have to go any further than my books. But yeah, O'Neill's books certainly would be the next set of books that I would read. With those books, there's really nothing else that you need to read that you're going to find somewhere else that's going to really add much at all.
Question, your cell signal
Especially
trigger.
You have the workbooks. I'm sorry, Bob, but you have these workbooks too. So I would study these workbooks, in depth over and over and over.
That's what I was going to just add, Mark. I think,
Yeah.
Long before, at least several years before any of Mark's books even came out. But for those of you who are more visually oriented, I would flip through the workbooks. Just flip through and use that almost as like pattern recognition for your eyes.
Yeah.
Yeah. And I know I talked to many of you as well on the phone, and I also would say anything that you're going to be learning from any other book or strategy is what Mark's already incorporated into his strategy that is relevant and helpful. So Mark's book already has the best of the best, if you kind of will. And in that sense, mastering Mark's strategy by itself is all one needs to become a successful top trader for that matter.
Yeah. I mean, even, David Ryan has said, and some other people that have, are authorities on the O'Neill work, has said that sort of mine is sort of the next generation of taking it to that next level and even a more forensic level. So, but I would certainly, add in O'Neill's books, which are great, or Bibles.
So last November, you had your cell signal trigger. Question is being asked, what were the top indicators you saw that prompted you to go on a sell signal? And follow-up is, how do you measure overall market health?
Well, the main way that we measure market health is how the individual stocks are acting. So everything that we've talked about, the last couple of days is showing you how to identify abnormal stock action and looking for these VCPs. And when you see a lot of stocks that are setting up, and you have these VCPs are breaking out, everything that we're talking about how the supply stops coming to market on an individual stock basis, and that creates that line of least resistance and that explosive potential. Well, think about that. When you have a lot of stocks doing that the indication is that the entire market has a lack of supply, and there's that supply demand imbalance, and you've got a healthy market as well. So a lot of stocks setting up. Stan Weinstein, who's a very good friend of mine, he does in a similar manner. He's not looking for the VCPs and that tightness in price on the right side. When he looks at the overall market for stage analysis, he looks at the 1, 2, 3, and 4 stages, and he calls the 2s the good guys. The 4s are the bad guys. And when there's lots of stocks in stage 2, that means it's a healthy market. And there's a lot of stage 3 after you've had a long stage 2 environment. Well, now you're looking at an environment that may be topping. So when we got to that, your question was around the November 22 sell signal. What led up to that, and I think Mark, you talked about that earlier, about we saw a lot of stocks that were breaking out, they were faltering, we're getting a lot of violations, and the participation you had, as I said, to our members would know this certainly. I had never seen the market in my 40 years of history, and looking back, I had never seen the market where we went to new highs after a long bull market, and you were near new highs, and there were less than 40% of stocks above the 200-day on the NASDAQ, and I think the New York as well, but certainly on the NASDAQ, and the market survived that without at least a good-sized correction. And it came in right on cue. Once again, the market did not survive that. That was the condition leading up to it.
Question being asked, does the VCP have an ideal time period? How long of a VCP would be most optimal?
Well, it's going to be, again, you got to look for symmetry, and it's going to be relative to itself and the market. So the answer is that they generally form over a number of days, to where you can have an IPO base and it could happen over just a couple weeks, to as much as 52 to 65 weeks. Generally, the longer ones are a year, a little more than a year. The average is 3 months to 6 months are the good size bases, but you can get periods where they're shorter. What'll happen is that the bases that form in the stocks will be sort of a byproduct of the underlying market conditions. So if you have a real big bear market, you're going to get deep cups, you're going to get deep corrections, and then you'll need more time to digest that supply because you have a deeper decline, and it'll go longer. So you'll have the longer bases. When you're in a bull market and you've got these stocks in stage 2 uptrends, you're going to find that the corrections will be smaller in the market. You may get a 6 or 7% pullback in the market, last several weeks, and you'll get shorter bases. So it's really a function, just like PE ratios are a function of the market. When the market's in a bull market and it's rip roaring, PEs are higher. The market's PE is high. When you're in a bear market, PEs are lower. It's just a byproduct of the overall market. But generally speaking, you want to look for the ones that are 5 to 7 weeks in the short side, to as much as 52 to 65 weeks on the longer side. The longer ones are going to take sometimes 3, 4, 5 contractions. The shorter ones could be just a couple contractions, 2 contractions even. And if you have really tight bases, they don't even need more than just one tight range, and those are generally in the power play. I'm sorry, the power play type situations.
All right. Questions being asked, if it's okay to have higher highs on the time compressions in the VCP, or does that indicate it is wedging up and possibly more failure prone?
Well, you're going to have higher lows, and sometimes you'll get some higher highs. There was an example that we just showed recently. I don't remember what page it's on. Maybe I can find it later on, but I don't remember what page, but it showed where there's a little sort of a high handle. Sometimes you'll form where you'll move sideways, and then you'll break out of a base that isn't tight enough, but then it tightens up and it sits right on top of the base. So sometimes you can have where there is a higher high, yes. But if it is wedging up on the right side, that's more of a determination that you have to make, and that's sort of getting into the art of it, of looking of whether it's wedging and so forth. But again, looking for shakeouts and drifting back is a better is a better setup. When you have shakeouts, that is what creates that last ringing of the towel and gets those last weak hands when you have that pullback in the right side there.
All right. One quick question. Someone was asking where they can get the glasses that has a VCP pattern within them.
Yeah, we're trying to produce those. I think once we, that'll probably be a big selling product. We can make a lot of money on those glasses probably. So yeah, I like to try to produce those glasses. We are giving you those glasses though. Your eyes will start to see things in that manner. and you'll get that template will sort of overlay. Mark, I'm sure, it went, over the years now, when you look at a stock, and David Ryan has said this many times, that, when we look at these stocks, we just immediately, it just sort of melds right into this template of like, we know what we need to see. Maybe you can speak to that. And also, we're looking, at the right side first. That's something that, David Ryan and I talked about a lot, where we start with that tightness and then work back. Maybe you can talk about that.
Yeah, I'd love to. And just, obviously the question is a little tongue in cheek and we're kind of laughing about it, but let's say, hypothetically speaking, that Mark could make those glasses. You don't want that, guys. You want to be able to develop your own ability to be an expert, and we use the analogy of training your eye. There's just, do the math. I've done the math in terms of how many charts I've looked at over the last 12 to 13 years versus somebody like Mark or David, who've been doing this for 40 years. His eye is still more refined than mine. He's looked at millions more charts than me. That's to your advantage. You've got the opportunity to develop your own set that no one can take that away from you. Once you have that skill, one of the things I love Mark says, once you develop that skill, you have it for life. So think of it in terms of you're in training to become an expert in identifying these things. And yeah, once you have that, people send me, what do you think of this chart all the time? And it's all noise. Most of the time people send me charts, it's like, guys, this is nowhere close to what I'm looking for, because my eye has been keenly trained, again, through looking at all these past precedents and then screening the market. I know what I want to see in relatively short order.
Yeah. Why would you want to give those glasses to everybody? That's your advantage, right?
Exactly right. Exactly right.
But we are giving them, we're basically doing that, and here, I think the real important thing to understand is, and a lot of people think that if we give these glasses to everybody, that it's going to negate the strategy and make it where, it won't work. Well, there is some truth to that. I mean, if everybody did this and everybody had this all figured out, if we could figure everything out in the market, yes, it would be truly efficient and random. I can assure you that's not going to happen. And if it did happen, and I've said this prior, but it's worth hearing again. Let's just say it did. Let's say everybody did it one way, the way that worked. We figured out the optimal way, the best way to trade the stock market. And I wrote a book on it, and it went around the world, and everybody started using it. Well, the theory is, well, it'll stop working. That's right. And guess what? People will stop using it. And then guess what will happen? They'll start working again. And that's why it's so important. And Mark Rich, he gets this, because that's why he's been sitting in cash for months and months and months during this bear market. And instead of switching to a different strategy or and changing his approach, we know that part of the approach is for it not to work for certain periods of time. And that's part of it working. It actually isn't not working. It's just that it ebbs and flows, and nothing works all the time. If this worked every day, I'd be a trillionaire. I'd be the richest man in the world. So there is, that's why there's discipline, but that you need. Let me go back right here too. So found this chart that we were talking about. So here's where there's a higher high. You see where you're forming above, and you've got a higher high, and it tightens up here. That's what I was talking about with that little high handle, if you will, or a little pivot that sits right on top. Sometimes maybe this right here was a little bit, didn't tighten up enough. It breaks out, and then you sit right on top of it. Just wanted to get back to that for you.
Yep.
Go ahead, Bob.
Question asking, with the IPO market changing so dramatically recently, with now companies not having to go public for funding, there's so much private funds available, private equity, and so the companies that come public are much greater and much bigger than generations past. So the question is, have you adjusted your methodology for investing in recent IPOs now that they do tend to come out much more developed and not as unknown as a result?
I don't think I would agree with that. So I'm not sure that that's completely true. There may be some truth to that, but I don't think there's any truth to that it's meaningful. I haven't seen anything change whatsoever as far as the market, the float, the size of the companies, things like that. Yes, it is dynamic, but nothing's really changed. I mean, since I've been doing this, going all the way back to the early mid 1980s. The only thing that's changed is things move a bit faster because we've got technology. So that's one thing. There's a quicker digestion of information or information flow, and the size is larger. Maybe there's more volume, but that doesn't really affect anything. The float, when you go all the way back to when Richard Love wrote Super Performance Stocks and did basically the O'Neill study first. That's where O'Neill sort of got the idea. O'Neill's work came from Love and Giller. It just basically just did what Love did, took the chart work from Giller, retermed the Saucerwit platform, a cup with handle, and perfected it, and basically did what I did. I took everybody's work before me, tried to perfect it the best I can, learn some new things, and added to that work and improved upon it. And I'm certainly will improve upon at some point, will improve upon my work. So again, when you look back, the float in the biggest winning stocks back in the 1960s, 50s was about 10 million shares. The float 20 years later was about 15, 20 million. Another decade, it was 25 million. Now it's about 30, 35 million. Really very little change, even in size and liquidity. So I haven't seen much change.
And that is literally the next question of asking if 95% of the stocks have a small float of 30 million shares or less. Is that to eliminate any large cap stock from this criteria?
No, not at all. That's just an average. And then you have to realize that there's periods where certain styles come in out of vogue. So you'll have, small caps have been out of favor for a long, long time. And at some point, you're going to have a raging bull market in small and mid cap companies. And that may go back to the previous point, who just said the previous point, that maybe that's one of the reasons, maybe that is partially the case where bigger companies, like you said, are being brought public and the smaller companies are not, trusted as much, or, they're certainly not getting their share of volume. But I assure you that at some point, there will be a raging bull market in small caps and mid caps. We go in and out of favor here. Mega caps we've been leading for a long period of time. And what was that? I forgot the question. What was the question? I'm going back to the previous question.
With the 30 million shares float being the 95% club, that eliminates most of the large cap names won't meet that criteria.
Yeah, again, that's just an average. So that's the average, but that shouldn't eliminate it. If it meets the criteria, if big caps are setting up and they're breaking out, then you should be buying the big caps. All things being equal, I would favor a stock with a small float. It's simple supply and demand. Here's what happens a lot of time too with the smaller companies, and the reason why they can do so well. You get Boeing, right? So let's just say Boeing's doing great, but Boeing is this big company, right? So it's hard to grow their earnings at a real rapid pace. But meanwhile, you've got Boeing's selling a ton of planes, let's say, right? But you've got this little company in Boise, Idaho, that makes the harnesses that bundle the wires in the planes, and they've only, they're a $100 million company, and Boeing's success gets leveraged with them. Now their earnings could grow at 100% a quarter, while Boeing's growing at 10%, because they're a little fish on the back of this big shark. So that's why you want to always look at these cousin stocks and the effect of having these smaller companies. Whenever you see these small companies, it's usually there's something going on that is creating that situation that they could become a big company, and they're usually piggybacking off of a big industry or another big company.
Mark, just to highlight that from the previous examples, though, Cirrus Logic was exactly that. One of the examples that's in the book a few times, they made iPhone parts. So at the same time, while Apple's having this nice run, Cirrus Logic went up, enormously because they were a smaller company along for that larger ride.
And that's a really great point, because a lot of companies piggybacked Apple. A lot of companies piggybacked all these big companies, and this happened back in the 1990s. I made a lot of money in a lot of computer peripheral software. They're all piggybacking the proliferation of computers with Dell Computer and Compaq and the laptops that came out, and the personal computer. And then I made money in American Power Conversion, because they were making the battery backups that people were using for the computers, and first personal battery backups and so forth. So this just is, and I covered this in the very beginning when we were talking about categories, how each industry will birth another industry, and companies will birth other companies. It's sort of this spin-off effect or cousin effect, if you will. And that's where you just constantly look down the chain. And usually, a lot of times you can look up the chain, because you'll find this small company that's got these big earnings, and then you come to find out, they're that company making, some product for Boeing or for Apple or for Google or some bigger company.
You mentioned small and mid cap. Question: how would you define a small or mid cap stock these days? What kind of market cap size?
I off the top of my head, I'm not sure if, I'd be fair to say the exact market cap. I mean, it used to be when I first started 150, 250 million was small cap. Now that's micro cap. But what I would say is I would divide the market. What I do is I try to divide the market into 4 quadrants. So the fourth quadrant would be the largest, take the whole market cap basically from 100 million up, and then divide it into 4 quadrants. And you'd have, whatever's below the midpoint is the mid and small, and above that is the large and mega.
Okay. A couple other questions similar to this. Is there a minimum average volume you use in your screening to ensure adequate liquidity?
Well, not really. I mean, down to yes, there is, but I won't trade a stock that trades 10,000 shares a day, just simply because the size that I have to put on to get a meaningful position. But I still look at stocks that trade 50,000, 100,000 shares a day. And sometimes I just buy 1,000 shares of them. And sometimes I'll watch them, because you'll be surprised. A company that's trading 100,000 shares a day, 6 months later may set up and it's trading 300,000 or 400,000 shares a day. And now it's getting that volume. As those institutions come in, that volume can balloon. When we go all the way back to the 1980s, when I first saw Walmart trading in the stock market, it was trading, I think it was trading a few thousand shares a day on certain days. I mean, the whole market at that time was trading, I think 40 million shares a day. These small companies can turn into big companies, and small traders can turn into larger volume traders. So even if I don't buy them, I'm watching them, but I just position size accordingly. If the stock's trading 100,000 shares a day, again, like I said, I'm not going to go in there and buy 50,000 shares, but I might buy 5. I might buy 1,000, 2,000, 5,000 shares. I don't know, Mark, do you have any cutoff? I mean, you're trading pretty big size now, relatively speaking to the average individual trader. I mean, you're certainly you need to get a pretty big position on. So
yeah, I used to never have a cutoff. And for screening purposes, though, normally, anything that doesn't trade, say, more than 20 to 30,000 shares a day, I usually kind of, I think that's my cutoff, say, in terms of the screens. Now and I'll usually, if I can't get a 1% position on where the position would have to be bigger than, say, 10% of average daily volume, then it might be in a void. The funny thing though, for those smaller traders, I mean, it's a great way to build up an account though. Trading some of the less liquid is not a disadvantage. It's an advantage if you're smaller, because there's where the inefficient pricing often lies if you do your analysis correctly.
Yeah, take advantage of that advantage when you're small, to buy the lower traders, the lower volume traders, because once you get where you're a big shot like Mark Ritchie, you won't be able to buy those anymore.
I'm going to interject another question because it's timely to that. But the question for both of you is, what was the most important adjustment you made when trading much larger size? So you kind of already answered that in a
I haven't made
question.
Yeah, I haven't made any adjustments at all. I just adjust the size that I buy relative to the average volume, but no adjustments. I haven't made many adjustments at all to anything that I've done, except that I think I'm just better at what I do. The confirmations and violations, I have perfected a lot more of really boiling it down to what's normal, what's abnormal. As a matter of fact, we've just developed a piece of software. It's called MonAlert, that our members get as part of the platform, and it actually watches the stocks for you and will indicate there's a bunch more violations and confirmations that it will watch the stock and then give you a report and tell you when those are being hit. We're we're in the process now of merging that with charting, where you'll be able to pull up a chart. We're going to have charting on the service. You'll pull up a chart and it'll actually show you, when those are happening and put them on the chart and read it for you. It's not going to be like where it does the work for you and buys and sells stocks, but it's a tool. It's a great tool. So we're actually automating that to a certain degree. And that's probably the only improvement that or the only things I've changed is I just improve the analysis and gotten more forensic on it. And we've just figured out more and more what's important and what really works, and just refine this.
Anything else?
Yeah, what was the question? Refresh. Oh, what do we change? Sorry, I was just trying to remember. I would just say I'm just becoming a little more incremental as the count has grown, for sure, in terms of putting positions on, where, when you're small, you can just go in right off the hop with your whole position. As you get bigger, you got to trade in more blocks so if I've got to buy more than 10,000 shares, I've got to trade in a few blocks or that type of thing. But, as far as the analysis, nothing has changed. To Mark's point, it's just been refining and continuing to get better.
Bob, real quick, I don't remember exactly where you had the hiccup, and because we have we're spread apart. We have guys in New York, Maine, Florida, South Carolina, Chicago, all over the place, all on Zoom. So, and I'm buffered here for a pretty long buffer. So I don't know exactly where we missed out, but I know we only missed like a couple minutes, a couple slides. And just to let you guys know, there wasn't really much I talked about. That's, it was just a couple examples. I think it was just this example that we missed. And I was just pointing out the contrast between the volume. It was just examples over and over from 174, 175 going on here. Same thing, looking at the 1-2 punch. So you didn't really, out of whatever the curriculum is going to end up being 30 hours or so, but a couple minutes, you didn't miss much. I promise you that.
Yeah, if it was a key point, we would certainly focus on that. But
I go back and I'd redo it right now if it was something really key, but it wasn't.
All right. Question, just as a follow-up with regard to that size of volume, and also is there a minimum float to outstanding shares that you stay away from a certain percentage where you want to see the float not be too small relative to the outstanding shares?
Not really. I mean, I've heard some concern over that, but no, I mean, I want the float. I'm concerned with, the least amount of supply and having the most amount of demand. So to me, a small float is great. That's really what's important when you're trading stocks and you're looking for the supply demand imbalances. The float is what's trading in the public forum. So that's the number that, regardless of how many shares are outstanding, the float is really what's being traded. So the smaller the float, supply demand. If you have an institution that wants to buy this stock, the smaller the float, obviously, the more that creates a situation where you can have an imbalance. That's what we're looking for. We're looking for a supply demand imbalance, and we're trying to time it as to when that imbalance gets to a point where it's very extreme, where you've got virtually no supply, as the least amount of supply possible, and the most demand intersect. That's the key, and it doesn't even have to intersect where the most demand is right at that point. The demand could come in later, like for instance, this chart right here, you can see very tight, right, and then the volume comes in. So obviously the demand is much greater now, but you see the demand continues, and that's what we're looking for. Something, and that's when you put the fundamentals, you put everything together, and you're in a strong uptrend. You're going to be in situations where you have the potential for more than just a blip. Something really great is going on, and if you get it right and you're at a profit right away, this is where you get into that situation where you can get your cake and eat it too. You get up at profit real quick. You can, you're up 20%. You could kick out half of it, set your stop at 8 or 10%, set it and forget it, and you want to hope it becomes the next Amazon or a big winner, and just backstop it. And now at least you're free rolling. If it stops you out, you don't lose any money. There's a number of ways. We're going to talk about all that later on.
I was going to say, you're getting into that's next weekend. But I will share with everybody, since of course I've gone through the exact same learning process that each of you are going through. Mark Ritchie is going through as well. And initially, the thinner capped or smaller cap names were the ones that scared me to death. And sure, when it doesn't work out, you could get hosed, some slippage. That's true. But our edge is even more to our edge in those smaller case situations when they work. And that's in an easy dollar environment. Much more often, you're going to benefit from that scenario than the times we're going to get hosed by slippage and stuff's being triggered. So
And
I
if
would
you-
share with you, embrace it. Ultimately, you want to embrace
Yeah,
this.
and if you think volume, I mean, the argument for so long was, I can't trade that. It doesn't trade a million shares. I hear these things on Twitter. Well, I mean, take a look at Facebook, and take a look at, these stocks that, that someone like Kathy would buy that, she's managing billions of dollars and can get into these names. Well, and look where they are now. It didn't protect you. It didn't protect you. That's not protection, that it trades a lot of volume. Getting your analysis right, timing them right, and getting this analysis right. This is what will protect you. Having that knowledge and skill will protect you much more than liquidity was ever going to protect you.
Good question here, Mark. Do you treat breakouts from pivot points from an analyst upgrade or news article differently than you would if there wasn't some story associated with it?
Not really, but usually when you get that, you get a gap. So I would normally stay away from it. Usually the only time I buy a gap is on an earnings announcement. So if the earnings come out much better than expected, the stock gaps, I'll buy it on the gap if the gap doesn't put it past my buy point. If it's too much past my buy point, 1%, more than 1% past my buy point, I'm not touching it. Once it goes 1%, that's it. That's my, sometimes I get slippage and I pay a little bit more. Might go in there and buy 5,000 at the market, and I get a bad fill, but I'm not trying to buy it more than that. So as long as it doesn't, it might gap up and it's not 1% above my pivot, it could be up 3% of the day. And it gaps from inside the pivot and it's above, now it's a 0.5% above the pivot, and I'll buy it because it's still meeting my criteria. So we still have to meet my criteria. On analyst upgrades, if it happens and the stock's extended and it's a lot of times I'll sell right into that. I'll sell into the upgrades.
Yeah, and we'll get into selling next
But
week.
I won't stay away from the stock. If an analyst upgrades it and it breaks out, I'll still buy it if it meets the criteria.
Okay. On that, just reading here, there was a question that was that just went hand in hand with it that I just lost somehow. All right. One of the questions that we're asking about volume at the time of the breakout, a lot of times it happens in the morning. How do you extrapolate the volume based on the real-time breakout?
Yeah, so you're not going to know, this whole 1-2 right here, you're not going to know that. Sometimes, obviously you need to see the end of the day volume. Now, of course, if it's 12 o'clock and the volume's already above the average volume, or you can figure that out, right? So if it's 9:45, it's 10 o'clock in the morning, and stock's breaking out, even extrapolating that early is probably not going to get a very good read on what the final volume will be. You could see if volume's coming in and you can see if the stock's moving on blocks. But, if it's real early, I'm just not, I'm buying the stock. I don't really require a certain amount of volume intraday. I buy the stock and then I watch to see if the volume comes in. The volume sometimes doesn't come in for days. Sometimes you get a low volume breakout. Usually the better ones will break out and you'll get the volume, but not always the really big volume. Sometimes when the really big volume comes in right on the breakout, it's a sign that there's a lot of eyes on it. And as particularly in the late stages of a bull market, you'll get these big volume breakouts because all the retail traders going in there and everybody's watching this stuff because now they've got confidence with it. The market's been going up for years and all their friends are making money. So everybody and their uncle is trading stocks, and those high volume breakouts, I like to see low volume breakouts in late stage environments. And then the volume sort of come in slowly in the beginning of a bull market. When you get in the earlier stages and, everybody's bearish, the big volume is relatively speaking, is a better sign. I can't say I have scientific evidence of this. This is really just my own anecdotal experience. But if I were to try to measure that, but your question is about early day volume. You have to extrapolate. If it's 11 o'clock, it's a couple hours into the day, you can then divide the day by how many hours and times that by the remaining hours, and you can see, what the volume is running. I don't know, Mark, how do you treat breakouts if they happen early in the morning and you don't see the volume? Are you still buying them, and how do you extrapolate the volume?
Yeah, absolutely. I actually don't usually even look at the volume. I used to do that. I just haven't found it's all that helpful, and sometimes it's even a distraction. But to Mark's point,
you're saying intraday while it's breaking.
Intraday, yeah. I would agree though that if I'm buying and there's just an absolute explosion of volume at the same time, that actually doesn't give me near as much comfort as it does pause. I would prefer to see the volume. I'd prefer to see sometimes the volume where the price is good and maybe the volume's just average. And then you see above average the next day, or then, that's the sign that the institutions, we say, we can break a stock out, but we can't keep it. We can break it up and break it out, but we're not going to keep it up. Where you want to just see the institutions are coming in steady order, because they're not going to put their whole position on in one day. So I
Yeah.
wouldn't get overly obsessed with that.
And two things. One, when Mark says we can break out, he means us retail traders. Doesn't mean him and I personally, although maybe with a small cap, a little tiny one we could, but it's going to be very, very little and brief. So yes, retail money can break a stock out. You might have a bunch of, and you're not going to know that at the time. And that's why those confirmations are so important, because a couple things. One, if you get followed through buying over a number of days, that gives you a good indication that now, there's real money and they're buying, because again, retail buying could not hold the stock up for days, for 2-3 days. And even intraday, it usually would come back down. It would just move it out. It was very short term and come right back in. And then the pullbacks, because most stocks that are under accumulation and there's really this lack of supply, and there's even one institution in there buying it, usually what happens is they don't pull back. They don't make more than 2 to 4 lower lows. That's why we watch for those lower lows. But after you break out, when it comes down a couple days and you get 2 or 3 lower lows, that's where the train should start coming on schedule. The volume should start coming back in, the support should come in, and then the stock should recover fairly quickly, because that's what tells you that it's not just retail money, that there's real money there supporting the stock.
Okay, I found that question that I missed, which was asking, if you're not able to be in front of the computers all day long, would you recommend using buy stop limit orders to avoid slippage like you mentioned in a gap scenario, or something to that effect?
Well, certainly that would be your only option. If you're not in front of the screen, then you have to. We have members and traders that I know for many years that have done really well, that exclusively use buy stop orders. Ralph Koppel always comes to mind. He's one of our members for a long, long time. He's been to, I don't know, 8 master trader programs. He's done really well, and he works a job and exclusively uses. I have a whole bunch of people that I could reference that I know that work jobs. Most people who are trading, work a job. Not, a lot less people are professional traders than are professional traders, especially when you're first starting out. So certainly, and I, if you saw how I started trading, and I don't know, do I even have it here? Yeah, I do. Hold on, I'll show you something here. I started trading on this right here. I always keep this on my desk. This little thing that didn't even give accurate quotes. Some of you might remember this was called a quote trek. It went by FM signal, and this was my internet connection. See that right there? That was my internet connection. So this always gets a laugh when we do this in person. So yeah, I was trading off of this archaic thing. So again, right now you have the equivalent of a fully equipped, F-16 fighter jet. You have so many with the bracketing orders, and there's just so many ways to protect yourself and to make sure that you get in at the right price. Trading is easier than ever. This is another total mischaracterization, characterizing the market. People say, oh, back then, trading was easier when, maybe when you started. When I started trading, the bid and ask spreads and NASDAQ stocks were $3 to $6, and commissions were $250 a trade. So, and there was no connection. We had to pick up a phone, call the broker had to call the floor. And sometimes we didn't get our confirmation that we even owned the stock for 30 minutes. So talk about try to manage risk there. Now you go into the stock, if it doesn't move 4 seconds later, people reverse out and sell, and it's done automatically with an OCC order that you preset. So trading is so much easier now, and those electronic options that you have are great to use.
Question is asking, during the bear markets, defensive and less cyclical companies are probably the ones that won't do well in the long term. Do you look at sector view, and do you take that into account based on knowing the four categories that you mentioned on page, I think 24, that are where the historical super performers come from?
Well, okay, so I mean, if a stock's a cyclical, then that tells you right there. Cyclical means cyclical, right? So you're not going to get a secular move out of a cyclical because it's a cyclical. Steel stocks, paper stocks, those are deep cyclicals. So these secular long big movers that can make moves over decades in the growth stocks, those are the ones that can deliver earnings even through recessions. Like we pointed out some of the names like Apollo, Panera, that did very well even when we had some of the worst, the worst bear markets ever. So I'm not sure exactly if you're asking me, cyclicals are cyclical, so they're not going to make those longer term moves. But you can have periods where the 1970s, which some people have compared this environment to, I don't know if I would necessarily make that comparison to that extent of the 70s. It was a much worse environment where you had interest rates up at the prime rate was 18%. People were odd and even gas days. People couldn't get gas for their cars. And just, interest rates were sky high. Inflation was sky high. Yes, this is, a similar type environment. We may get a bigger move than we've seen in a while in some of these oil names and these economically sensitive names. Maybe that's why the Dow's leading right now. But again, yeah, generally speaking, you're going to want to go with the groups that are historically the winning groups. Those are going to be historically the winning groups going forward. I assure you that, because they can grow the earnings. They have the scalable business models. They have the business models, that can grow earnings, huge earnings for an extended period of time, and aren't tethered to the underlying economy so much.
Similar follow-up question asking about those four categories listed on page 24, with them out of favor, predominantly out of favor in a bear market. Do you just not trade? Is essentially the question.
No, well, again, we're going to trade the stocks that set up, and again, if we were to say, well, we're just not going to trade anything, and we're getting all these names setting up, and let's just say like the oil group, that's been sort of the hot group, which I bought the XLE a while back, and it made a nice move in some of these oil names. So if you were to have that kind of rigid approach, you might miss a really great, maybe even multi-year move. Maybe it's not a decade move, but you might miss a multi-year move. So you just got to look, and the stocks meet the criteria. We buy them. However, again, I'm certainly going to favor, the growth areas, and you're going to have a much healthier market, a sustainable market. When you go back and you look at these big bull markets, they're led by these type of names historically. You don't see many bull markets that are these big bull markets and these secular bull markets that are led by cyclical stocks. So, but again, don't overthink this. That's the thing. What I'm trying to show you here is give you a very straightforward way to, and again, we talked about a lot of things, and it sounds like a lot, but really what it really boils down to is looking for stocks that are in uptrends, waiting for a pause, a consolidation, buying them coming out of those bases from low risk entry points by determining when that supply stops coming to market, and looking at earnings, sales, and margins. That's it. I mean, that's really all we're looking at. We're not going into all these other forensic accountings and balance sheets and return on equity and book value and which groups. And no, the stocks will lead you to the groups. Okay. And the stocks will lead you to the good markets and the bad markets. When you get stopped out of everything and there's no stock setting up, we're in cash. When the stock starts setting up, we start putting our money to work. Are we going to pile in? No, not until the stocks give us the feedback that they're working. They start working, we know, okay, the environment's pretty good here. We put more money to work. And that forces you in the bull markets, forces you out in the bear markets. And if you just get the skill to do that effectively, you're going to be better than all the Wall Street analysts. All the analysts, all the opinions, all the gurus, you'll outperform them all. Okay, because most people are out there trying to trade and invest on guesswork, on prediction. None of us can predict what's going to happen. We're all the good traders are just cabooses, they just, and they're following the engine, and we're not trying to be the first in, and we're not, we're and not the last out either. Usually, we're trying to get that meat in the middle and get that, I'm not an early adopter. I'm a mid-stage adopter when it comes to the trend of a stock. So I'm in there when the momentum's the strongest. That's the key. Where is the momentum the strongest? You don't want the lowest price. You want the right price. The right price is where momentum is strongest, and you can make the most amount of money in the shortest period of time.
And that's a golden nugget right there. Mark, question on the JetBlue Airways that you bought. The question, the airlines being a capital intensive, heavily regulated group, therefore not a typical growth industry. Wondering your thought process that led you to buy JetBlue Airways.
Yeah, I don't remember exactly. I'm not even sure if that. I know that we had the JetBlue example. I don't think. I think I was in Southwest Love, but Southwest Love. There was a few airlines that were producing growth stock like earnings. Were very progressive in that industry. But again, I treat those like a cyclical. There you have deep cyclicals, like you have the steel, the papers, stocks like that. Then you have what they call growth cyclicals. That would be like a semiconductor. A semiconductor is partially cyclical, but but they can grow their earnings, and there is a growth component. And then you have the growth stocks, of course. Certain airlines are at some periods were like growth cyclicals. And so again, I'm not going to go in there and say, oh, airlines are setting up and they look perfect and they're breaking out of bases and they got strong earnings, and not buy it because it's an airline. It's setting up, it meets the criteria, I'm buying the stock. It's that simple. I've been doing this long enough to know that I don't know, and the stocks are going to be much smarter than me. We mentioned this before, Mark and I, in the bear market, the COVID decline. I was absolutely terrified to buy stocks when we came off the lows. I did not know if it was the end of the world. That was something that I had never seen before. None of us, probably alive, have seen that pandemic like that. Didn't know what it meant. The news was so horrible, and that first good bounce off the low that went into April, we got follow through today in April. I think it was April 6th. We were buying stocks, and Mark called me up and he said, there's stocks setting up, but I mean, we're not going to buy in this environment, are we? I said, you bet your butt we are. We're going to buy stocks. I mean, we're going to put our toe in incrementally. If they work, we're going to buy more, and we got to trust the market here. If not, we get stopped out. Mark goes lower lows and we try it again, and that's the name of the game. And what happened, Mark? It was a great environment.
The rest has been history, as they say. I'll just add though, because we've been getting this question a lot in the last year, because there's been if the only thing that's really been setting up consistently has been the cyclical type areas, specifically oil and gas, commodity related. And I'll just say, look, if they set up, I look at them generally more as a trading opportunity. So if it's not in that, that group where the biggest winners in history come from, doesn't mean you can't trade them. And if you're a trader, maybe you're just agnostic to the whole thing because you're not playing names for a bigger move. Which is really how I started, but I'm going to be more willing to, if I get an average gain, I just, book the profits and move on.
I think also, I have a luxury where, I've been trading for 40 years now. I'm a wealthy man. I don't need to find a stock that goes up 80,000% and have this big stock to make me rich. Mitigating risk is even more important to me than ever. So everything's pretty much a trade for me now. I swing trade, and I've made the majority of my money on the intermediate term and the shorter term trading. When I say shorter term, I'm saying, we're talking like 20, 30, 40, 50% moves, occasional doubles, not these big multi-year movers. So a lot of times we get the question, well, why are we looking at all these big giant winners if we're going to swing trade them? Because preferably I like to trade the same stock 20 times and make 1,000% on a stock that went up 50,000%, and I traded it out of 5 bases, or, along the way. I mean, there's some stocks I've traded, go back and, pick names that I started trading in 1990 to this day. I'm trading the same name, and I might have traded it 50 times in 20 or 30 years. So again, now, but I want that option. So we whether I'm buying it for a swing trade or for a long-term move, I still want to be at a profit right away, because I have to manage the risk. You see, the stock doesn't know how long I'm going to hold it. And the only thing that I have on the table when I put a trade on is risk. It's all risk at that point. So I put my money up, let's just say, whatever, it's $1 million I put into a trade. I have $1 million at risk. Well, that stock, I'm planning on, I want to hold it for a big move. Well, if it runs up 20%, I can sell part of that, and I can backstop it. Now, if I want to put a 20% stop, sell half of it, I can give the stock 20% now and play for that big giant move and give it lots and lots of room if I want to play that game. If not, I have a nice short-term profit in a short period of time. If I just flip out of a 20% mover every couple of weeks or every couple months, I'm going to get to a big return as well. So I can get there either way. But the options open up for me. Once you're at a profit, if you get at a profit right away, your options open up. You have other options and tools that you can use in tactics that become risk-free or risk-adverse. And that's the whole key, is to get yourself into a position. We're going to talk about this later, but about improving your worst-case scenario. In the very beginning, it's all risk. Here, in your worst-case scenario is your stop. Or if it gaps against you, your worst case scenario is 100%, and that has to be taken care of by position sizing. Once the stock goes up, and now you start maybe paring out some of your profit, and you start cushioning yourself, and you maybe bring your position size down, now your worst case scenario changes. You might have a break-even worst case scenario. You might have the stock's up big and you backstop it. You might have a worst case scenario of making 20%. It's up 40%. You put a backstop at 20. Now your worst case scenario is a profit. So we're always trying to improve our worst case scenario. And that's what can put you in a position to have that big mover and do it risk-free.
Quick question. Is there any difference in the way you screen in a bullish market environment versus a bearish market environment?
Very little, except I'll tell you, like in a bearish market environment, when the market's in a bear market, I'm paying close attention to stocks that have their relative strength lines hitting new highs. So, and that's again in MarketSmith. We're going to go over MarketSmith, a bunch of ways that you can screen with MarketSmith on live trading day, and we'll go over all that. But that's when I want to see stocks where I want to screen for stocks that are hitting new highs. RS lines are hitting new highs, because this is where you can have a stock that's just not even going up, but it's going down less than the market, and it's the relative performer, and those are the ones that are holding up the best. And like we've said many times, it's like a spring being compressed, and when the weight comes off of it, they take off. We've looked at that Peloton example that was similar to Cisco, where the stock came off, but within just a few days or weeks, it was a new high ground, that it just that spring just unloaded into new high ground, and that relative strength line is telling you everything, that stock is super strong in a weak market. So what most people do is that when the bear market, they go and they buy. The average guy has been buying Facebook for the last several months. He's been buying Amazon from when it was down 20%, thinking they got this big bargain. They're all underwater now. Everybody's underwater. They've been buying PayPal and Google, then they're getting a bargain. And again, if trading was as easy as going to the biggest companies, the best companies, and buying them when they were down, everybody'd be rich from trading. I mean, everybody would be at least have a great returns. And the sad fact is that the majority, upwards of 90% of investors that are stock traders lose money. They lose money, and the money funnels to a very small list of competent investors and traders, but the majority of people lose money. So it's not that simple. But what I was trying to say was, you want to buy the strongest stocks, not the weakest, in a bear market.
There's a question asking if there's
One other thing,
any,
Bob, I'm sorry to interrupt, but one last thing. Also, in corrections, say you get a 6 or 8 week correction. Sometimes what I'll do is I'll run a 6 or 8 week relative strength, and then it'll find out what stocks held up during that correction the best. Now, these are what I call utility screens. But generally speaking, I run the same screens. I just run RS screens. I look and I do the work myself. I'm looking for stocks in uptrends with the high RS, like I said, the improving relative strength lines in a bear market, and the same thing with the 6 or 8 week or 10 week. You have a 10 week correction, you run a 10 week rate of change or RS, and now you're seeing what stocks held up the best during that correction. I don't know. How about you, Mark? Do you run any screens any differently?
Zero actually was what I was going to say. I've literally been running the same 3 screens, guys, since I went to the first Master Trader program in 2010. And the only thing I've changed, I think, is just a volume qualifier, where I used to not even have one. Now I have a little bit of one. And then I think on 1 or 2 of the screens, I used to run everything above maybe $3. Now I go everything above like $8. So I don't do anything different.
And the reason is because the screening that's not where the magic is. That's not what's going to make you rich. That there's no magical screen. We're all looking at the same names. We all end up with the same list of names. There's only so many companies that are growing at X percentage, are hitting new highs, are coming out of bases, have relative strength lines hitting new highs. All this stuff we're talking about at any one time, there's going to be a handful of companies. And there's millions and millions and millions and tens of millions of traders out there. We're all looking at the same names. So what differentiates a Mark Ritchie or a Mark Minervini from the average guy? Skill, and using these are tactics and tools. Just like what differentiates, I mean, Judge gets up at bat. For those of you who know baseball, of course, Aaron Judge gets up at bat. What differentiates him from the guy who bats 185? He wields that bat better. They both have a baseball bat in their hands. Everybody's got a hockey stick in their hands, but not everybody's Wayne Gretzky, right? Because he uses that hockey stick, he uses that tool better. So the key is these are the tools, and everybody's got these tools available to them, but only a certain number of people are, and that has nothing to do with ability, because anybody can do this. It's the commitment, it's the willingness, it's the discipline, it's the persistence, it's the patience, it's the willingness to stick with a strategy and to learn everything about it and not drift and to become an expert in something. That's the difference. That's the difference. I mean, again, there's so many people here, but there's billions of people out there. They're not all here on this webinar and watching this session. That makes you special right there. That puts you already in an elite category.
That actually is a question that was just a few questions ahead of me, Mark, but I might as well get it answered here. Why is Mark so much better than everyone else who uses this approach? William O'Neill's theory and Mark's books have been around for a long time, and many investors use similar, if not the same strategy. So, okay.
So why is it that it's so many people are obese and overweight? Why is that? Everybody knows you eat less and you exercise. If you took a 3-mile walk every night and didn't, unless you have a medical condition, but for most people, if they took a 3-mile walk each night and ate less carbs, they would be and went to the gym, they'd be fit. So everybody has the same access to the information. There's all books written on weight loss, and there's gyms everywhere. So why is that? Well, because the discipline, the willingness, the discipline, and this is not easy. Just like losing weight. If you're overweight, it's not easy. It's not something that you have to work for it. You have to go to the gym. You got to be disciplined. You've got to do the right things. Well, the same thing here. This isn't a magic formula. Once again, if I just give a magic formula, you just press a button, I'd be a trillionaire. Or I would destroy the market and make it perfectly efficient, which that would never happen. So the bottom line is that it takes work. It takes work. And then the reason why Mark Ritchie runs the same screens for 13 years is because there is no magic screen. You still have to roll up your sleeves. You got to look at the stocks, and you got to determine which ones are the ones that you're going to focus on. You got to buy those buy points and have the courage to buy them when they're breaking out, sometimes in a market where it looks like hell. And you've got to have the discipline to manage the losses, to manage the positions, to sell the positions when they're up at the strength and watch them go up, go to infinity. there's the saying Paul Tudor Jones said, I buy stocks that go to zero and sell stocks that go to infinity. I've been doing that for 40 years. I sold Cisco 5 points off the IPO base to watch it go up 70,000%. That would affect some people, and they and cloud their judgment. But I've sold and I've taken losses on stocks that went down 5%, turned around and went up 100% in just a couple months, and sat there and watched them while I just got hosed. So again, that's part of it, discipline, and most people can't do it. They just don't have the discipline, and they don't have the belief in themselves and their strategy, and they drift, and they're always looking for the magic formula. There is no magic formula. The formula that's magic is the one that works well for somebody, and then you learn that from that person, and then learn how to execute it like someone else who's successful. That's why we go to coaches. That's why we go to golf coaches and batting practice. But there's a lot of bad coaches too. So that's the first thing. Got to find something that works for somebody else, and then discover what they know. That's why you're here.
Mark, I'll just add a little bit of color to that, because my favorite quote, I think, from your first book is the idea that discipline is a hallmark of greatness. Meaning it doesn't matter what craft it is, discipline is going to be essential if you want to be great. But just to your gym analogy, I used to, I still work out. I'm not at a gym, but there used to be a group of regulars in any gym in America. They'll tell you that the busiest weeks are the first 2 weeks after January, and all the regulars hate it. And they're just waiting for all the New Year's Eve people to tap out and quit so they can, not have to compete with them for machines and weight. It's the same cycle every year. And I used to actually, when I was just out of college, I worked at a gym, and they would always say, get all your new memberships in before the end of January, because then they're not going to show up. They're not going to sign up till next year. And it's the same cycle again and again. We see this in markets, though. Market's good for a bit. A bunch of people come in, think they can make a fortune, and 6 months to a year become multimillionaires. And then, they learn the hard way that it's not quite that easy. They don't want to put in the work, and they get rinsed out. So it's no different in any other areas of success, in my opinion.
Yeah, when I was young, many years ago, I did bodybuilding, and I transformed myself from a little skinny guy to a pretty big muscular person that people who knew me, they didn't even hardly recognize me after a while. But I used to go to the gym, and I would see people a year later. Like they're there on January 1st, and then January 1st a year later, and see them working out, and they look exactly the same. And I'd say, don't they ever think that maybe they got to try something different? Or what I did was I went and found the guys that were had the best bodies and the diets and the most successful people, just like I did with stocks and everything else. I listened to them, I watched them, and I emulated them, and I learned from them. And if it didn't work, then, I find somebody else that, until once I found something that they were doing really well, and it made sense to me, then I committed to it, and I stuck with it. So a gym membership isn't going to give you a great body. You still got to go there. You got to put in the work, the discipline, you got to have the knowledge. What happens, even with this program, is that people get the workbooks and they're all excited. And then, 6 months down the road, a year down the road, when the realization comes that there's actual work, those workbooks are sitting with dust on them. So are you going to be one of those people that has dust on your books? Or are you going to be one that's studying them and putting it into practice and learning from your mistakes and constantly refining and committing to this? And years later, like Mark says, he's got stacks of these books, and we study this stuff. I've been doing this for 40 years. I still study the market and do precedent analysis and study my mistakes and do post analysis. 40 years later, I'm not good enough or smart enough not to study.
Question for Mark Ritchie: when you lost money in the 3 years since 2010, which mistakes did you make, or what were the lessons that you learned?
I don't think you lost money.
Well, meaning, when I had periods, where things weren't working well. Yeah, I wouldn't say it was necessarily mistakes, but or certainly not style drift. That's kind of the big mistake I think people make. You get into a period where, breakouts aren't working. I love one of the Master Trader programs. I think it was, 2018 or 19. I've told this story a few times. One of the last ones we were in person, the market had been tough for maybe 6 months, and everybody at every break, every bathroom break, every lunch, people pulling me aside. These breakouts don't really work anymore, do they? Everybody's asking me that, and that kind of gave me the clue. We're gonna have a really good period coming up here, which is why I'm excited right now, because I think when this baby turns, a bunch of people are going to be skeptical, not trading the setups, just like Mark told the story in 2020. For me, probably the biggest thing is just over trading or not. If there's a mistake I've made in the past, it's not heeding the action of the market. And Mark and I talk about the trading, sort of this loop we'll get into, in coming days, of respecting the feedback in your own portfolio. So if things aren't working, you've got to, bend with the market and trade smaller. That's probably the only thing, I would say, in terms of looking back in hindsight, but, I wouldn't really do anything, majorly differently.
So here's you want to talk about a perfect point to make here. Here we are doing this seminar, as Mark just said, in 2018, and I've heard you say this many times, and I've heard this a million times. People are paying $5,000. They're flying. Some flew from India and from around the world to come to a seminar on breakout strategies, to then go up to Mark Ritchie and say, this stuff doesn't work anymore, right? Like, it with disbelief. There is everything I just said. That's exactly, and that underlying what that really is. That's a lack of confidence in the self. That's self-image problem. That has nothing to do with the strategy. Those are people that don't believe in themselves, and it transfers, and it manifests itself that way, where they just feel skeptical about a lot of things. Maybe they had bad experiences, whatever it is. It's an underlying thing. But again, that's precisely what happens. So that person, when that person goes into this with that mindset, the minute they experience difficulty, that's it. It's done. They give up. They throw it right away, and they go try something else that they think works. But nothing works in perpetuity. So you're gonna come to that crossroad with every strategy, with everything, no matter what. So I just think that's really a good point.
We could talk more about this on Monday with Scott Sinclair, but a quick question: if you could share the difference between the 5-month on the Marcus Smith trend template from Mark Minervini, the 5-month versus the 5-month wide.
Let's not waste time right now. And let's talk. We're gonna cover Market Smith in depth. So we're gonna go over the trend templates, and so let's cover that then.
What would be the best time frame to analyze a chart, weekly or daily charts?
Well, I use both. I'm always looking at a daily, and I look at a weekly. So I trade off of the daily, and the weekly gives you information to see where it closed in the week. And look, the charts are going to put the same analysis, whether it's a daily, weekly, or even intraday chart. You're looking for the same exact thing to occur. So the weekly is going to give you data or information on weekly bars. So you'll see where it closed within the range of the week, where on a daily, you won't see that as clearly. But I'm always looking at a daily. I trade off the dailies. I like that level of granularity. I don't trade off of intraday charts, 3-minute, 5 minutes. I don't look at those. I do have one on my screen, a 5-minute, but I don't trade off of it. And the weekly is looking for the longer term, the longer term trend, and looking for the where the stock is closing weekly. So there is some information on the weekly that is also important, but I use both, and Mark does the same.
Yeah. Quick question: how you are ordering your screens of your stocks that you're reviewing? Is it by relative strength or RS rating? Is the question.
Well, I don't know if we're talking about like on my screen on my platform when I'm trading throughout the day, or prior to that.
Screening for searching for names like Teladoc and Zoom and DocuSign back in the COVID days. Are you screening and sorting by a relative strength rating?
I sort by relative strength rating. Yeah, that's how I normally sort. If you want to look at, I know someone asked about the SMR rating in Market Smith. If you want to look for the stocks that are maybe the strongest fundamentals, you can put a relative strength cutoff, and then so now they all meet at least a certain relative strength number that you don't want to go any lower, and then you can sort by the SMR rating, and that'll bring you to a lot of stocks that have the earnings to sales and the margins. But what I do is I'm always looking for the relative strength stocks that are strongest, the highest alpha stocks, and then from there I look at the fundamentals and all that stuff by hand. You know, like I said, I roll up my sleeves and I do the work. So yeah, I'm sorting usually with from relative strength. When it comes to IPOs, I'm just sorting in from the earliest IPO back, and I'll show you that on Monday. We'll get into, you know, questions on market smith and screening. We're going to cover all that on Monday.
Quick final one then. If two stocks are setting up technically identical, one is in a stronger group than another, would the group strength influence your decision-making process?
Not really. If they're both, no. Usually what will happen is if two stocks are setting up identically, I'm going to buy the one that breaks out first. So I'm going to let the stock, I often say, I don't pick stocks, I let stocks pick me, or at least I don't pick which stocks I buy. I let the stock pick me. You do have to select which stocks you're going to focus on and which stocks are going to be the candidates that you're going to buy once they get through a buy point. So if there's a bunch of names, you have to decide that these are the ones that I'm going to buy if they get through this pivot point. So once you get to that point, you've narrowed your list down. Maybe you got 5 names today that are setting up. The one that breaks out first is the one that I'm buying. And if it happens to be the one in the weaker group, then I'm buying that, because you might get both of them might break out. That one might break out first and the other one might break out. But if you wait for a particular stock, 4 of your 5 might break out, and the one you're waiting for never breaks out, and it tops right there and gets clobbered. And that, so again, the group is not going to supersede the individual stock. Not for me, at least. How about you, Mark? Would you, would that influence
No,
you?
yeah, no, and generally, yeah, it's don't try not to have favorites, buy in the order of breakout, set alarms. And there've been many times where you think this stock A looks really good and it's going to go, and then stock B breaks out. You buy the one that breaks out. And because I've seen many people waiting for the first one to go that never goes, and then they miss the one that does. So you're much better off. Again, I like to default and say the market's smarter than me always and all the time. So why not, let it tell me, which way I should go.
I've told this story before, but I started off when I first started in the market. When I very first started, I knew nothing. I was completely oblivious, and all I did was buy stocks that were $2, $3, $4 stocks that were trading with low PEs. Everything the opposite of what I do now. I had some success with that early on just by luck, and that led me to doing some really stupid things and blowing my account up. Luckily, I didn't have much money then. But I started off when I first started doing this to the point where I wanted to have a strategy and really understand a disciplined approach. I started as a what we would call a quant, where I would do macro work and I try to figure out where the market's going. And then from there, I look for the best groups in the market, in a strong market, the strongest groups in the strong market. And then from there, buy the stocks in those groups. What happened was I kept buying stocks that weren't going anywhere. And then I would look and I'd see these stocks that blasted to the moon, but they had met my criteria for the individual stock criteria way prior. So I was saying, why am I missing these? And the reason why I was missing them is because the leaders lead. You'll have rogue stocks that will set up and break out way before, sometimes before the group gets hot, and definitely before the market turns up big in a bear market. Those stocks will bottom first. They'll be in a stage 2 uptrend before the market turns in a stage 2 uptrend, which I showed you many examples. Amazon was one of them. All these stocks, every stock that we looked at, those were in stage 2 uptrends prior to the market. Very few turned up after the market. And so I was late. I was constantly missing the leaders because I by default, it led me to laggards. So I flipped the whole thing around. I said, I'm going to start with stock. Then the stocks are going to lead me. If there's stocks breaking out, then that's going to lead me to a good group. And then if there's a lot of stocks and groups acting well, then the market's probably healthy. And my entire financial life changed from that point on. I never had a down year from that point on.
Mark, you rarely trade stocks that are below $10 or $12 a minimum threshold, but sometimes you will trade stocks $5, $6 in price. What is it about that stock that made you consider that? Is it a fundamental or technical or both type of criteria?
2 things. One, I don't even screen for stocks that low. So usually it's one of our members or maybe even Mark Ritchie sometimes will tell me about a stock that's lower price stock. I'm not sure how he found it, but he comes across it. So, and I'll see it, and it might be a really great setup, and I might buy some. Usually it's a much smaller position. I'm careful with those lower price names. Or it's a power play. It's a really strong power play. And once again, usually somebody else tips me off to it. And then I'll consider it even more seriously if it's a real high alpha power play. The power plays, the ones that are really, really strong, and it looks like something big is going on. A stock that doubles in a couple of days or a couple of weeks. Obviously something's happening, something's going on positive. It's just a matter now of whether it's going to continue, and just getting in on a low risk entry. So those are the scenarios that I'll generally trade, but I try not to even see them because then I might get tempted to go into the junk pile, and I try to stay away from that. It's just not necessary. Once again, when we go back and you take a look at, you could look at O'Neill studies, you could look at, I basically did the modern day version of O'Neill study. I wanted to confirm everything that Love and O'Neill found and make sure that, it wasn't happening in a modern time frame. What we found was when you look at the biggest winning stocks that go up the fastest, the biggest, these super performance stocks, they start their move in the 30s. So nowhere near, like there was no need to have penny stocks. Virtually none of the biggest winners made their big move from a penny stock or a really low price stock. They're all, before the big move unfolded, they already were 15, 20, 25, $30 a share or more. So I just found it to be unnecessary. Now, certainly there's stocks that make big moves that are low price stocks, but again, you're lowering the probability. Another thing real quick for those of you, maybe I haven't said it yet, but when you go into the really low price stocks, all this firepower we're talking about, this institutional firepower that we're looking for where the supply stops coming to market. The reason is because we want those institutions to come in, and they're big demand, low supply, right? That creates that explosive price action. Well, when you go into the really low price stocks, there's only certain funds and hedge funds that can buy those stocks because they're too low priced. So that eliminates a whole bunch of your firepower. So that in itself is a big reason to avoid those. Second of all, when they're low price, it's an indication that it's a lower quality company and situation to begin with. And when you start getting into where you have a liquidity issue, you have to buy way more shares. I mean, I love when stocks don't split, and the stock's trading at $2,000. Now, I only have to buy 100 shares, 1,000 shares to get a position on that. If the stock was $6, I'm gonna have to buy hundreds of thousands of shares, and that will move the stock. The stocks move on volume, on blocks, and not necessarily on as much on dollar volume. So again, there's a lot of reasons why you want to stay away from the low price stocks.
Good question on valuation. Mark mentioned basically ignoring it. I believe O'Neill mentions in his book that once a PE has doubled from the initial entry point, that the run may be close to over in a stock. Does either Mark Ritchie or Minervini take into account this consideration? I'm pretty sure we showed how a PE doubles is one of your slides, Mark.
No, but we didn't get to that's in selling. We have not.
Okay. So then
we have not gotten to selling, and we are going to talk about that's called PE expansion. So don't interpret O'Neill as being literal, that because his PE doubles, he's going to sell the stock. Absolutely not. That will tell you that the stock has moved ahead of the earnings dramatically, and you should start looking for specific sell rules, which I'm going to show you exactly how to do that when we have the selling, which is, I believe, day 3, right? Which will be next Saturday. So now sometimes a PE will triple and quadruple. So selling at a double the PE is, will be way early. So again, a lot of times that won't even happen. So you really got to be really careful when you start looking at that stuff. That's going to be something that's going to lead you off track way more than it's going to keep you on track. But it's more to display, to try to And what O'Neill is doing, and what I'm doing when I talk about that, is showing you how when the stock starts running up faster than the earnings, at some point it becomes unsustainable, and you want to put that all together. We're gonna talk about base counting, looking for late stage, stage 1, stage 2, stage 3, stage 4. When you put this all together, you get a picture. You start to get an idea of whether you're early, you're late, and that is going to that's going to tell you what kind of tactic and what you should be looking for. So again, you're in a late stage move. You're coming off your 5th base. PE's tripled. Everybody and their grandmother knows the stock, Chipotle, whatever it is, Netflix, and the stock, runs up. It has a huge acceleration, and now you're seeing a bunch of sell signals, a bunch of things that we're going to talk about later. Now you should be, getting the heck out of that thing, as opposed to stocks breaking out of a base. It's a first stage base, and maybe the PE has doubled, but it's just started its move. You're coming out of a bear market. That wouldn't even affect me at all. So again, everything's relative, and there's a lot of, you have to think, when you think linear, you got to try not to be too linear with trading. The only thing you really want to think about linear is the stop, the stop loss, the risk. When you put a line in the sand, that's it. There's no ambiguities there, and you have to protect that. You have to protect that downside to a mathematical ratio that makes sense with your, what you expect on the upside. And those breakout levels, when you set the pivot points, it gets through that buy point. As Ed Secoda said, being bullish and not being long is illogical. So, doing all that work to find a stock that's set up, it sets up that pivot point, it breaks out, and you don't buy it, is illogical. So those are the things that are more linear and sort of lines in the sand. Everything else after that is really, there's a lot of subjectiveness. There's a lot of gray areas, and thank God there is, because that's why, poker players, chess players, there's skill involved. Even though there's a lot of mathematics behind it and probabilities, it still comes back to the operator.
Mark, in your 40-year career, can you share what periods of time have been the most challenging for your strategy, and how would you rate 2022 in terms of difficulty to those previous periods?
I would rate 2022 as one of the least difficult. This has been, it would give it, I had almost no reason whatsoever to get aggressive in the market, and it's been really not much volatility. We've had the VIX go up to 30, 36 maybe. Not a lot of volatility. Rallies haven't been huge or long lived. So there's really been no real true FOMO rallies that forced you in and then forced you out. There's still been tradable opportunities. There's the market's been sort of split. So I would say 2022 has been a relatively easy year. This has been, one of the easiest years that I've seen. Even 21 was treacherous for most people. But if you just figured out what I figured out early on, that we were getting lots of breakouts. Stock after stock was breaking out. And that's where it caught everybody, because they'd break out and then they'd fail. But most people, they stayed with that swing trading, and they'd taken, the losses were too big for the gains, and they weren't taking the gains very quickly. If you just ratcheted up your stop and took those gains real quick after 1, 2, 3, sometimes 5 days, you made a fortune. We've got I got friends of mine and members of Mintermedia Private Access that made huge returns, big triple-digit returns. I saw a couple of people I know that made a bigger return than me, that I made 300 some odd percent in the U.S. Investing Championship. I know people that made bigger returns than that on pretty big chunks of money too. So now you said what was the most challenging? I'd say one of the most absolute challenging was the 08-09. That was beyond treacherous. I remember O'Neill said the same thing, that was a real treacherous environment. That was probably the toughest environment that I've seen. 2000, I called the top really beautifully, and I got out. I wish I shorted along the way. I was short on 9/11, but I didn't play the short side as much as I should. I wasn't nearly as good trading, and I had never seen anything like that before. So I was really scared of the environment. But that was a really tough environment because it was so long. Other than that, Those are the two really difficult environments that, but 08, 09 was the worst environment. It took a while, even after the market bottom, there was so much volatility, you just get whipped all over the place.
Yeah, and I was going to say, it's not because we were ever blindsided by a bear market and lost due to that. I think it's
Never.
an important point to make, Mark. It's just a fact of meeting stocks meeting our criteria and taking them. The volatility, the excessively high volatility, makes for what we call a hard penny environment, not the easy dollars. We're looking to trade easy dollars,
Yeah.
but that is what it is, not the fact that we got caught up or caught in the downdraft of a bear
I have
market.
never been caught in a major downtrend ever in my entire career. And even when I wasn't good at this in the beginning, I have never ever been caught in a major. We weren't even caught in the flash crash. I got out
That's right.
before the flash. Yeah, and I basically, I don't want to say I predicted it, but I called it right as it was happening. I said, looks like we could be down 1,000 points here easily, and we got out days ahead of everything, and there were signs there. So 87 crash, I was out before the 87 crash. Again, that was kind of by luck. I didn't really know what I was doing back then too well, but I knew enough when stocks were selling off and hitting stops to get the hell out, and that's really all I had to know. And it was
Yeah.
way in advance of the 87 crash.
And there were a lot of cyclical bear markets throughout the late 90s that were really opportunities, nothing to be worried about from getting blindsided by the markets using Mark's risk management strategies.
I mean, Mark, have you ever been caught in a major downdraft and not get out, like, early on?
Never. And I would just add too, I think that was one of my questions early, in 2010. I had sidestepped the flash crash as well. Probably a little more by luck, but similar to Mark's point, you just had stops of, the leading stocks all got hit before the market really opened up big. And I remember asking this question at the first Master Trader program. So you're telling me if you just follow the stocks, that will keep you out of trouble? And of course, the answer was a resounding yes. And that has been true to form in every one of these. We've had a number of cyclical bear markets. Obviously, the COVID decline was pretty vicious, guys, but you had ample warning there too. So, and it's not luck. It's, again, the market. There's an intelligence at work here in terms of you're going to see it in the stocks first.
Yeah, you have to go back and take a look. Do some post analysis. If you are stuck in right now, let's just say you're stuck in the market, you're down big, you go back, it's because you were arguing with the market in some form. Whether you just kept trading and I bought the breakouts. Yeah, but they weren't working. So if they kept if 5 trades in a row don't work for me, I pretty much throw in the towel right then and there. I might try another 4 or 5 with smaller size, but if I get stopped out 2 iterations in a row and I'm getting nailed, now I'm down 4, 5, 6, 7%. That's it. I'm going in when I say the turtle position. I'm going into total protection mode, and I am going to have to see a lot of evidence and get traction on small increments, and I just build my way very slowly. So I'm always looking at the risk side first. So you're either arguing with the market by you keep trading the same way and you don't make any adjustment, or you just hold and you don't throw in the towel. You don't say uncle, and you hold the stocks down and you wait for them to come back, and before you know it, you're underwater. I'm sure many of you can relate to this, and you've done it at some point. We've all done this. Mark and I, we don't ever do that. Ever. Not one single time am I ever going to hold. And I've been doing this for 40 years. Okay. And the thing that you have to fight after 40 years is thinking that you know something and thinking that you're so smart. And you start to think, well, I've seen this before. The stock's going to bounce back. Never. Not once. That stock goes down, goes against me, hits my stop, I am out. No questions asked. I don't trust my opinion. Okay. So, and if breakouts aren't working, then I either stop trading, or I trade smaller, or I start selling into the strength. I make an adjustment. I don't adjust my strategy. Okay. Here's a very important distinction. I always say you could be flexible with your observations, but not your philosophy. You keep your philosophy. We have a very sound philosophy. We've got a great strategy, but I have to be flexible with my observations, because there's going to be certain tactics and certain conditions that are going to require me to do nothing. And that is the big difference, I think, from a Mark Ritchie and most people, is number one, the discipline, but the fact that he'll stay risk adverse for extended periods of time. But then when things change, he'll step on the gas and put the pedal to the floor. So being able to make that shift and make that adjustment is sort of the gas pedal of the car. The engine, you got the body, you got the engine, and then you again down to that operator with that driver. That you can't discount the driver. Is so important. This is the car, and we're giving the engine. We're going to give you all the tools and the tactics, but then you have to apply them.
Just a quick comment. I remember that question you asked Mark in 2010, and I thought this guy's got no chance. That's just a joke. All right. So next question, Mark. Question is being asked: is it normal that you have
bet, Bob? It would have been a very bad bet.
Would have lost a lot of steak dinners on that one. Yeah. Is it normal that you have a large percentage of your annual returns come from a few blowout stocks?
A few blowout stocks, the large percent of the annual returns? Yeah. Absolutely not. It's just the opposite. Complete opposite. It's a lot of rolling pennies, nickels, and quarters. It's the singles, it's the keeping the losses small, and a lot of the small gains adding up. For me, I very rarely have really, really big winners, even in my biggest return days. And even back when you needed a much bigger move, because when commissions were, when I first started, I had a couple $1,000. Then after that, I had $10,000. And before I made a lot of money, my account that I grew by 35,000% started at $32,335. That was my starting, because I was in the recording business. I sold my recording equipment, and I paid off all my bills, and I took that money, what was left, and I put it into an account. It was $32,335. And that's the account that I ran up 35,000% over the next 5 years. So I didn't have much money back then. So we had to make big moves to cover the commission, because I wasn't buying many shares. The commission was like $200 a trade. So you had to, you go buy 50 shares, do the math, how many points you need just to cover commission. So even then, very shortly after, when commissions came down to about $60 and you were able to trade online, I started swing trading right away. I realized that I could now take advantage of shorter term moves, and it was a little bit bigger then. Probably my average gain was up 15-20%, and I'd get 50% move swing trades more regularly. Now it's probably you're about 10-12% on average. That may sound small, but that's actually pretty big. That's for swing trading. If you can average 12%, 12, 13, 14% average gain, and your loss is 4, 5, 6%, and your batting average anywhere mid high 40s to low 50s, you should be printing money.
Absolutely. Question asked by if I'm mainly looking for big moves, what would be the difference, or what would be the difference in your tactics between swing trading and a long-term strategy? This might be more on the selling section as well, Mark.
Very little would be different in looking for the stocks as far as selection, in entering them as far as entry points and buy points. Very little would be different. The difference would be you'd have to be a lot more patient, because now, in order to make a big move, well, you're going to have to go through pullbacks, and you'll have stocks that are up, let's say 30-40%, where we would be absolutely protecting that. As a swing trader, would never let a 30%, 40% gain turn into a loss, or even probably undercut maybe a couple previous lows. So you're going to have to go through pretty big pullbacks. This is like Amazon. We talked about this earlier, where would you really have held Amazon through the 50% pullbacks? In the 90s, it was a 90% pullback. And even now, let's just say Facebook goes on to go up another 20,000% in the next 5-10 years, whatever it is. But you just went through a 75% drawdown. So to make those big returns and to hold a stock for its whole lifespan, you got to look at the volatility and see, would you really have held? Would you have been able to go through those drawdowns? So even at a more micro level, stock breaks out, you're not selling them up 10%. And if you are, you could, like I said, getting the best of both worlds is what I would do if I were to go for those bigger moves, because the big move is going to offset the smaller position size. So if you say you're up 20%, okay, kick out half. Now you keep your stop loss and you set it and forget it. Once that stock gets up a certain amount, maybe move it to break even. Now you've guaranteed yourself a profit, and now you can go for that big move. That's the only thing I would change.
Quick question for both Marks. How much work or research do you do before you invest in a market leader, which you do not know, but just looking at the price action?
Okay, well, Mark, I'll let you answer this after me, but it depends. I mean, if it's a stock that is setting up beautifully, all the numbers are there, and it's breaking out, maybe I just find it this weekend, and tomorrow, in the morning, it starts breaking out. I may not have the time to do that research, and I'm buying it. I'm going to buy it. I'm going to shoot first and ask questions later. So I'm always covered with my position sizing and my stop loss. So it's not like I'm shooting the moon and I'm risking my life on this decision. So that's the main thing. You have to have, position sizing correctly and use stops. So I'm not afraid to take a position, something maybe I don't know a lot about yet, as long as the numbers are there. I mean, quant funds and those who, there's some traders that they use pure technical analysis. They don't look at any fundamentals at all. Okay, so you can, that's an approach. Some people believe everything's in the price. I believe most of everything is in the price. Most of the news is in the price. So and then I'll start looking into it. So it depends on the situation. Many of the stocks that I buy, I know already because I've been watching them. Some companies I know about from 10 years ago, and then all of a sudden they set up and they start coming to life. They go into an uptrend, the earnings start coming in, and I already know everything that they do and all about them. There's other companies, there's maybe some small company that I haven't heard about, pops up on my screen, and next thing you know, it's moving out right away. I don't know. How about you, Mark?
Same. I would just add, though, I think it's that ability to shoot first is a huge advantage. That's the beauty of this approach. While there's a lot of other players, especially institutions, they're mandated that they can't do that. Think of the advantage you have over them. But I would add the same thing. Normally, it's pretty rare that, you see something I've never heard of and it's set up perfectly. Usually it's on a secondary watch list, or, like an on deck list, as Mark calls his, and then it's in the hole and then it's up to bat. So you have a little bit of time, but often, I'll just say to, my partner, Brandon, I'll go, who are these guys? Let's, put that name on a list to do a little bit of tertiary, research, but I don't pour into the fundamentals of these companies. I just kind of want to know a little bit about the company. I don't sit there and go, mark this one to do hours of, fundamental work. It's usually just trying to understand the group, a little bit of maybe they have a new product or something like that, especially if they have decent fundamentals. I'll do a little bit of, looking into why that, what's driving those.
So a few important distinctions here. First of all, let me just explain what Mark is saying. Also, when he says the advantage of this approach, he's not just necessarily saying that this approach doesn't need any analysis versus he was contrasting that to the big guys, that have to go and get an approval list and have boards. It's because of size. It's because of size. When they've got to take multi-million share position, they got to make sure that this company's not going to blow up tomorrow. And there's a protocol, there's a mandate. Being small, you can act very quickly, and you could reverse if the stock moves down and moves against you, you can get out real quick. A big institution can't do that. They can't reverse their multi-million share position that they built up over the last month. And because it hits a 5% stop, or suddenly they don't like what's happening in the company, they just cut and run in the press of a button. That's the advantage. Is that speed, and that is our approach. It is our approach, as Mark said. The other thing, what was the other thing I was going to say? I wrote it down and I can't read my own writing. It's so scribbled. I don't know. I'll see if I remember it. I wrote a note down. It's so scribbled. I can't. Oh yeah, that's right. Fundies. So fundamentals. I early on, I was really doing a lot of fundamental research, like conference calls, talking to investor relations, talking to the CFO. This got me in some real trouble a few times. Even when I was cutting my losses and I had my strategy pretty good, the 90s, early 90s, I got on a few names that I was so certain that the fundamentals were so good that I held them. I held them down, and I didn't cut my loss. And unfortunately, I didn't blow myself up, but I gave back. It cost me a lot of my return, and it cost me a lot of money. So if you build a real, like I said, with the cheap trap, if you're buying the stock because it's cheap, well, then the cheaper it gets, the more attractive it is. And that goes against that will fly in the face of risk management. The same thing with fundamentals. So now, and we talked about how stocks top before the fundamentals go bad. So if you're buying it based on the fundamentals and you're weighing too much to the fundamentals and that overshadows the technicals, well, now you may not manage your risk, and also you may be late because stocks discount. Stock will break on a good earnings report, and you're like, the fundamentals are still great. And let me just tell you this: whatever you do, don't ever trust the company. Don't ever trust the CEO or anybody that works for the company, because they're the biggest liars that you could ever have in the world for a company. They're the spokespeople. They're the dog and pony show, Barnum and Bailey circus act, that they're going to say anything. Usually they own stock themselves. The last thing they want to do is have their stock go down. They're going to say anything to keep the stock up. But I could tell you right now, they can't hold it up. A CEO, all these things that, they'll go on TV and say everything's great when they absolutely know that things are turning down. And I've seen more bullshit stories come out of people, CEOs and CFOs, than all the analysts on Wall Street. So you got to make your own determination on the number. Are they delivering? If the company's so great, well, then why are the earnings not coming in? And if the earnings, let's say the earnings aren't even coming in, well, if it's so great, why isn't the stock performing? So if the stock's performing well, see, it has to make sense. So let's just say there are no earnings, but the stock doubles in 4 days. Well, that tells you that the stock is trading on the future or not trading on earnings. Maybe it's a biotech, whatever it is, there's a good fundamental story there. But let's just say the earnings are huge and the stock breaks and it's down 20% in 2 days and it's hitting a 52-week low. Well, if the fundamentals are so great, why is the stock acting so poorly? Okay, so that's where sort of that differential comes, that differential disclosure. And if you start digging in with the fundamentals, that differential disclosure, you won't utilize it in a way that's going to serve you. If that makes sense.
A couple questions here on staging. So one question real quick: how do you know when a stock is in stage 2 from stage 1? That is the definition of our trend template. So that's
it's in my books, and it's also, you have the on whatever page it is here. Let's see, where is that page? Where is that? Hold on. I think I just spun by it. Sorry, take some time here, but let's just find the page. So I just want to have a quick discussion on that real quick, and just to give one note on it. Here's the trend template. So here's the criteria, okay? And the key is to understand is that you want all this criteria, all 8 of the criteria. It's not just a couple of them or the weight of evidence. It needs to meet all this criteria. And if it doesn't meet all 8, you're not in a stage 2 uptrend. Now you can go to the templates, and if you want an early turn, which won't meet all that criteria, that will have the 4 to 5 months, you can see those early turns with the 1 month template, and that's in MarketSmith.
But the follow-up question to that is, how do you know, which is going to play a 2-part question, how do you know when the stage 2 is becoming a stage 3? Which you don't really tell afterwards. But 2, the related question to that, Mark, is how many bases is typical of a stage 2, which then can let you be able to more easily identify when you might be entering a stage 3.
Oh, that we're going to talk about base counting later. So let's keep that for selling.
Okay.
Yeah, we'll keep that for selling, and we'll talk about that later on, later stage. That's where we start putting together. We talked about PE expansion, base counting, and things like that. I think there's also a stage 3. I think I have a stage 3 slide that talks about the characteristics that you're going to see. But in stage 3, you're going to get that more. And we talked about this. We did talk about this. Here's a perfect example going to Lululemon on page 44. You see, you start getting more volatile. You see, this is this, and this isn't logarithmic. Maybe I should use a log scale. Let me see what's on a log scale here. Here's a log scale. So you see here, this very efficient. See how the pullbacks are through this entire move, really shallow. This is all alpha. If you were to measure this, this is high alpha, low standard deviation. But then suddenly you've got these wide swings. See this here? That's not a cup with handle, even though it looks like a big base. It's just too deep. It's too deep. It's wide. It's loose. It's all over the place. And this is starting to look more stage 3. So you have this big break right here, right? And then you see it would form that handle and then it breaks down. So this is where you start getting late in the game. And like I said, we're going to talk about this later about counting bases. Another one was Lulu. You had that big break here. You see that big giant break here, and then it can't rally, and then it breaks again. This is the type of thing that you're going to see in stage 3, as opposed to where I'm buying it here. Very efficiently makes that nice first move, goes from 25 to over just about 65. You get a double in a very short period of time, see, with very little pressure. It's never comes back to your buy price. You're at a big profit right away, and all your pullbacks, tennis ball action, tennis ball action, tennis ball action. Then finally, as the volatility starts widening, you start getting into the later stages. So volatility is the first tip off, is the volatility, then the big breaks, the volume, and then finally, the moving averages flatten out, everything starts rolling over, you go into stage 4.
Question of asking, what is the typical move or average move you can expect from a stock emerging from a proper base? Is it a measured move, which would be equal to the depth of the base on the flip side, on the breakout rather?
You do not want to get into that type of analysis and ever think that way. If you think that way, you will be limiting your upside in stocks that can go up. There is no upside. I mean, if you bought Amazon off of that first base where I bought it in 1997, it went up tens of thousands of % from there. So a measured move would have led you to sell it way too early. The whole idea is to create asymmetric leverage, to go into a situation that has, virtually unlimited upside and cap the downside and create that skewed bell curve. So I wouldn't get into that thinking. I don't know, Mark, maybe you can comment on that about you don't set targets or have any upside projections when you go into a stock, right?
Yeah, and the idea of measured moves is not, part of the vernacular we ever use, but there's a reason for that though too. I think it's because we're focused on that inefficient pricing. This idea of a measured move is, we're looking at something, we're trying to find those areas where we think, even a small amount of incremental demand can move the stock very rapidly. Well, why would you use some type of a measured move analysis for that? To me, that speaks more to, I don't know, trading markets that are very efficiently priced, where you can think, well, historically, what would this do? We're looking for something, guys, that's explosive, where, a measured move analysis just doesn't, it's almost like, I don't know, using the wrong tool for the wrong project, if you will.
Let's just apply that measured move theory to some of these stocks that are in these 1, 2, 3 stages, right? So here, if you measured move here from the top to the bottom of this base would bring that up to about here. And look what happened, right? All right, let's go here. Here, measured move. You're coming out of this base. Maybe you measure it from here to here. Here's your first cup with handle. I mean, look at the upside versus the measured move. Here, another measured move here. Let's say you use this big giant, this would be a huge measured move, right? Use this big giant decline and you say, okay, measured move, turn that upside down. It brings it up to about here. It goes up way more than that. Every one of these, look, measured move here. These are not dying out at a measured move. When you get, now that's, again, if you want to sell it, at that point, that's fine. You can trade and maybe, you get a measured move and you get many measured moves along the way of these shorter term chart patterns. I don't know, but that's doesn't never come to my mind.
All right. On page 21, Mark
21.
said 90% of his slides are not in cyclicals, but can he share his trading experience and how he still found growth stocks in the 2003-2007 bull market where cyclicals like energy and financials were the leaders?
I don't remember that, to be honest with you, that they were the leaders, but there were stocks that were setting up. eBay came out of that period, Amazon. So there were stocks. I don't remember that period to know that cyclicals were the leaders. I can't really remember.
Google. I mean, come on, guys.
Yeah, I was going to say, I think there were no tech names.
04 was Google, right? Yeah.
Right, but 03 to 07 is right in there.
Yeah.
All right. On page 44, Lululemon. Even in stage 2, there were multiple corrections over 10, 20% or even more. How did Mark manage through that volatility? Did he hold the position through the entire stage 2?
I did not. I sold into this first move right up here. I was out, I believe, in this move right here, right into this 1, 2, and up here. Usually the way I trade the swing trades is I try to go through 1 or 2 natural reactions. If the market's good, things are acting well, I try to let the stock go through a correction, get it back into new highs. And if it can do that and show me that it's acting well, I try to go through a second one. And then usually the second or the third is where I'll sell into the strength. If I'm lucky enough to get a third, I might sell half of it into the second one and then hold it, move my stop up. If I get that third, I sell into the third. And that's usually the meat of the swing move. And then from there, the volatility, once you go through 2 or 3 natural reactions and the stock's marked itself up 20, 30, 40, sometimes 50%, then you usually have to go through a bigger pullback, just like you have here. Now you go through a bigger pullback, usually cut previous lows, the moving average, and then it gets more volatile. It's harder to get back on board. That's for someone who's playing for a much larger move. I'm not usually doing that. So usually, and in this particular instance, I was out in that first nice leg up, that nice efficient leg up.
I got a couple questions on, actually, let me just stay here for a second, because another question on this Lulu stock. When the stock was in a stage 2 uptrend, it cut below the 200-day moving average, then rallies, pulls back again, spends about 5 to 6 weeks below the 200-day moving average or 40-week moving average. Why is that still considered part of the stage 2 uptrend as opposed to on page 49, when the stock breaks below the 40-week moving average, it is off the radar?
Well, it depends. I mean, like, again, you went through this whole topping phase. I mean, this is just a pullback and then it rips right higher here. You didn't really go through a real topping phase, and you didn't even flatten out on the moving averages. So stage 3 is you're going to start seeing a flattening out of the moving average. You're going to take out, you're going to stair step down. It just doesn't, again, it's not meeting the criteria, the technical criteria. You haven't put it at a real top here. That's not to say it can't just keep going down, but at some point, the moving average would flatten out and turn down. You're going to get these undercuts, but again, I'm not going to be buying from here. I'm buying when it's clearly in a nice uptrend above it, in these more efficient and less volatile periods. The volatility is going to pick up as you get later in the stage 2 and the bases get later. That's exactly what I just said before, that you're going to start seeing the volatility. And that's how you're getting later and later in the cycle. And then when you start flattening out and getting the breaks and you start rolling over, that's the stage 3 into the stage 4. Again, there's an art to this. We're not going to just be able to say there's this perfect criteria that we're going to know exactly when it changes. And you're not going to know a stage 3 is a stage 3 until after it goes into stage 4. Otherwise, it might be a stage 1. It might just be rebasing, and then it moves higher again. And now that was just a stage 1. Rebasing all over again before it goes into a stage 2. A lot of this we can say is semantics, but it's not. There's specific criteria to be met prior to you buying the stock. Okay, so am I going to buy the stock here when it's below the 200? And maybe the 200 might be flattened out, or let's just say it's in an uptrend, but it's below the 200. So then it doesn't meet. We'll go back to the criteria. Where's the criteria? What page was that on? Sorry. Let's go back to the criteria.
21.
Stock is above both 150 and the 200-day. So it has to be above that. So it would be off the radar there at that point. This is only criteria that's your qualifier to buy. Once you're in the trade, Holding it, that's a whole nother element now. Whether you want to hold it and let it come all the way back and undercut the 200-day, what you're at a profit now. If you bought, and what slide was that again? 40. What slide was that?
44.
I'll go back.
40.
If you're buying this where I'm buying it here, well, that should be your problem. Whether you should decide whether you're going to hold through the pullback and let it pull back to the below the 200 when you're up over 100% already. So again, that becomes a whole nother decision process at that point. If you moved your stop up maybe to break even here, now you're working with big profits, you take some off, you've guaranteed yourself some profits. Now maybe you backstop it. You say, okay, the stock's up 100%. I don't want to give up more than 50. You draw a line in the sand. Now you can let that stock do whatever it wants to do above that line. 200 days, whatever it is, doesn't matter. It doesn't matter because you've drawn a line in the sand and that's where you're going to protect it. It's just a matter of managing risk versus reward once you're at a profit.
I think the Yahoo example in 168 mark also gives a good example of where that stage 3 actually became a stage 1 with a reset.
Well, yeah, right here where it started looking a little bit toppy, but then it tightened up. See, again, it tightened up and then it broke out from there. Now, you'd have to measure this and decide if you want to play this. But yes, this turned into what looked like it could be a stage 3 going to a stage 4, but it didn't break down. If you had moving averages in here, you would see they'd be flattening out here, but then you turned back up and you went back into the stage 2.
Page 48, could you do a quick summary review of that this is the transition slide showing you stage 1 transition into stage 2.
Right, not stage 3. This is going from 1 to 2.
Yeah.
What's the question?
Well, this was just a question somebody asked, but you're kind of answering that question. How you determine that stage 1 transitioning into stage 2 is they were just asking.
It's right here. This is the criteria, and this is the criteria that you're looking for. Maybe when you're in the early turn. So if you run the screen on MarketSmith the early turn, you're going to want to see this criteria that you're transitioning. Then from there to be in a confirmed, what I call a confirmed stage 2, you've got to meet all that criteria that's on the other page that we just showed you.
57,
which is in my both my books too.
And on 57, next question is if you need to have the 200-day, or ideally need to have the 200-day in an uptrend for at least a month, does that mean a stock has to have 200 trading days plus another month for the trading days so that you have that criteria being met? No,
if it's a new issue, you're not going to be able to be in the stage 2 uptrend. So IPOs, we're just looking at the price themselves, and we're not going to be able to qualify it that way. So if it's an IPO of maybe a year or less, recent IPO, then we're not looking at the stage 2 uptrend because you're not going to have the criteria, obviously.
And just a quick definition of an early turn,
which we're going to talk about the IPOs later. So we'll show you that, and we're going to cover everything. Yeah. Don't worry.
Yeah, IPO is this Saturday. But a definition of the early turn.
The definition of an early turn, it's the criteria is essentially the same, except that the 200-day is only up for a month. You only require a month. So it's a little loose. It may be we do have the criteria, of course, in the template. So there is specific criteria there. I can't remember exactly. There's maybe a couple things in there that I had them put in there that I don't remember exactly, but it's essentially the exact same criteria. The only difference is that you just don't have the trend in place. So it hasn't been in place long enough. And the reason why we did that, and that I still look at stocks that are early turns and not in confirmed uptrends, is because when you have a power play, which the stock takes off really fast, sometimes the ones that are the best are the ones that are dead for a long period of time, and then all of a sudden they just explode. So the moving average is the 200 days kind of flat or slightly trending up or down, and when the stock moves up so quickly, it doesn't give the time for the 200-day to turn up and to be in an uptrend. But those are sometimes the most powerful situations. So that's the caveat. The caveat is IPOs, where you don't have the data, and when you have a power play that blasts off from a period of dormancy, that's when we'll cut the stock some slack and we'll look for the early turn. Other than that, I'm not trading early turns. Not usually, or very seldom. 98% of the time they're in confirmed stage 2 uptrends.
Question on natural reactions. Why don't you use a natural reaction as a new entry point if it sets up?
You certainly could. You certainly could, but you're paying up now. I mean, if I have a buy point, I expect to be in before the natural reaction. I mean, the stock's coming out of a base, and coming from a cheat or handle. Well, that happens before the natural reaction. So just like a low cheat is going to happen before the cheat, a cheat's going to happen before the handle. So you might say, well, why not just buy cheats? Well, not every stock sets up a cheat. Why not just buy low cheats? Not every stock sets up a low cheat. How about handles? Not every stock sets up a handle. Some stocks set up all three. Some stocks set up none, and they just blast off the lows, which I won't touch. Some stocks come off of a low cheat and go straight up. So again, it's a matter of where that buy point is available. But I'm looking for stocks in bases. So I, by default, if I'm doing my work every day, I'm running my screens, I'm always going to see the stock before the natural reaction out of a base because I'm going to see it come out of the base first. But yeah, you could maybe, the first natural reaction that pulls back to a breakout, you're essentially accomplishing the same price. So say the stock breaks out at 20, runs up to 21, 22, pulls back to 20. Okay, now it's the same price as if you bought it on the breakout. Now you have to ascertain if that natural reaction is looking natural. If it is looking natural, yes, you can, that would be a secondary buy point that you could take. Well, I don't do that too often. Mark, how often do you think you buy from a natural reaction?
Yeah, and I was going to say not very often, but and my suggestion would be, if I do that, I'm usually only going to be adding a smaller because, meaning I don't want to run up my average price too much. And I'm also generally going to be tighter. If I do that, I'm going to be tighter on that second add because I'm expecting the stock, if it's a natural reaction, to Mark's point about tennis ball action, I'm expecting that to turn and be a new high ground relatively quickly. So I usually would be smaller on the add and even tighter.
But I think he's asking about just buying it, cold from not having a position already on.
Okay,
Right.
so yeah, well, ideally, then I would, want to know why did I miss it? If there was
Right.
a prior buy point, but potentially, I will, but it has to stand on its own, meaning that buy point, if all things being equal, has to be, whether I own it or I don't own it. So that's kind of how I think about it.
So two things.
Yeah.
One would be the only time that I usually would do that is when I missed it. When I missed the breakout, or I might have not taken it because I was bearish on the market. Maybe I was just getting beat up in some trades and I'm down and I decided I'm not going to take the next few trades and that trade breaks out. Now, maybe in the time where it pulls back and has that natural reaction, I've taken a couple other trades. Things have improved a bit over the couple of days or a week or so. And now I'm in a better position. And because I missed it, I might buy it on that natural reaction that pulls back to the breakout. That's first of all. Second of all, I would never buy a natural reaction that didn't come out of a base first, because then it wouldn't even be set up for my criteria in the first place. So it would have to be coming off of that set of circumstances, that VCP to begin with. And like I said, by default, I should be already seeing that because it happens beforehand.
Yeah, and the follow-up question was just that if I missed the breakout, is that an opportunity to get into a name that I might have missed as a result?
It could be, yeah. But if you're buying it extended, if that natural reaction is now 25% above the breakout, now you're paying up for it, and it becomes riskier, and there's obviously less juice in the lemon because you've gotten some of it out of there already on the swing trade. So I want to get it coming right out of that base. That's the area that you really want to focus on. But yes, you could absolutely buy it from that point.
Yep. If you could go to page 62, there's a question, large bases in the third stage. Can you clarify what you meant?
I was just saying that, when you're in a stage 2 uptrend, and again, this lends itself to, am I in stage 3 here, or rebasing stage 1? So you have a large base, and see the moving averages, the 150 is the green and the 200 is the gray. This is an early turn, but it's not a power play. Right? This is a stock that's coming out of a big base. This can sometimes happen where if you get a really large base, you'll have an early turn and they can still be playable if they meet all the criteria, because the large base has made the moving averages flatten out. And sometimes with very large bases, you just won't get that criteria coming out of the base. It will still look like an early turn and not be in that confirmed stage, stage 2. We have 4 or 5 months of uptrend. So it's a little caveat that, sometimes you can play these. It's a judgment call at that point.
Page 91.
Doesn't happen that often though. 90% of the time, you're going to be in the stage 2 uptrend clearly. 91.
Page 91.
Yep.
How much weight do you put on the future earnings estimates? And he's asking, particularly in this example, 2023 estimates are up 33% with an estimate of $1. Oh, no, I'm sorry. He's using another stock that he's just giving an example, but 22 years out, it's showing estimates are going to be down. Do you tend to not focus on 2 years out estimates as opposed to the year
2 years out? Analysts are lucky if they get 2 quarters out right. So the whole idea of this slide was to make the exact opposite point, is that they don't do a good job of estimating. So, and the stock is what does the job of the estimate. It does a better job of estimating. So again, no, I don't. The current year, I will look at, and maybe 1 or 2 quarters forward. After that, especially if there's large earnings, after that, you're going into no man's land where nobody knows what is going to happen there. So if there's a breakout year, I was talking about breakout years. Let me see if we even have that here. Example here. So in this breakout year, we've got part of the earnings are already on the table. So you've got this quarter's up 200%. So you look here, the estimates for 2014, right? This is 2013. This is your first quarter of 2014. So we're starting to see a good start there, right? It's supposed to be up 293%, $8 versus 204. Well, that's coming in right on that first quarter there. So I'll take that estimate and look at it being such a big increase here, $8 versus 2. I'll look at it as a breakout year, as a potential breakout year. So that will definitely play in my decision making. But I want to see that some evidence that that's happening, and I'm seeing it right here. You're seeing the acceleration in that big quarter with the big sales right here in that most recent quarter, and that's what led me to buy it right here. See, we're setting up perfectly, nice and tight here. You've got the pivot point. Everything's setting up perfectly. You've got the sales and the earnings accelerating, and you've got a breakout year with part of it on the table already. So yes, that estimate. But then going forward from there, I don't take much of that. Once you get after a year or so, forget about long term. Matter of fact, just the opposite. If you've got a company that say has not been doing very good, and then or you look at the earnings and they've improved over a number of years, and now the 3 to 5 year growth rate went from where it was 5% and now it's 50%. When you get that confidence in the long term, that means a lot is on the table. That's a sign of later stage, when you start seeing that 3 to 5 year growth rate has improved a lot. So you got to be careful again with estimates. They're just estimates. They're not. Look at what's on the table, and you don't really have to forecast much. When we go back, we look at the studies. Where's the slide? Let's see here. I don't know these off the top of my head, but sorry. Trying to find the categories and catalyst section, Bob, where we have oh, here it is. I got it. See right here. When we look at the biggest winning stocks, 70% reported earnings of 20% in the most recent quarter. You see, the grand majority of the time, the earnings are already on the table. You don't have to guess. You don't need to use estimates. They're already on the table. So that look for the earnings to be on the table already.
I'll keep going in page chronological order, 98.
98. Yep.
Question to clarify, wouldn't this be 100% increase in profit margin going from 1% to 2%, but you just referenced 1%. So not understanding that you're using just the actual net change.
Yes, it has doubled, but I'm saying a 1% increase in profit margins has the effect that it has. It is still only a 1% increase. Did they double? Yes, they doubled. They doubled from 1% to 2%. Absolutely. But that was my point. My point is that you can have a company that has a 2% margin, well, can increase it by 2%. That's a double. Yes. But that 2% can change everything because it is a double. those small numbers, you're getting that large number on that small number is leveraging your revenue.
Yeah. So it's a nominal change of 1%, but it is a 100% increase. Is
Yes.
what the
Yeah,
clarifying.
and that was here. That was what we were looking at with the Ollie's bargain. The margins were up. It's only 6.7 to 4.7, but that's a 42% margin increase. That's why we're looking for those large margin increases. This is turbocharging the revenue increase. The revenue increase is 16.8%, but that's on larger margins. So that now turbocharges that. And that was what was I trying to say was that if you didn't have that, you had a 7.81% EPS growth as opposed to having a 50% earnings growth.
Yeah. Yep. Page 104. Got a few questions on code 33 here.
Mm-hmm.
One of which is just explaining the numbers under the chart and how important is that in your trading?
Well, this is just to understand when you're looking at the earnings and sales. All I'm putting here, the matrix, and I think I said it backwards when I was talking about this. If you have a 33, it means three of all three are accelerating. So if you have a 31, it would be the first line, which is the EPS. You'd have 3/4 of EPS, and so forth. If you had a 20, 23, it would be 2/4 of all three are accelerating. Bottom line is you just, if you want to have as much of this on the table, you want to have 3/4 of all three. If you can get that, you don't always get that, but the more acceleration you have and the stronger it is across all these areas, the better it's going to be. And that goes right back to this example. You see, if you just had margins that stayed at 4.7%, well, then you would have only about an 8% EPS growth. But that margin increase, having that code 33 where you've gotten or having all three of them moving higher, acts as a multiplier. And that's why you want to look for that leverage. All this is about leverage points. Again, when you have margins increasing and revenue, that's where you can get gigantic explosive earnings.
And the factor of it happening over 3/4 is the consistency. That's the real trend is in place.
Yeah, so, and if that can happen, we talked about the Apple situation. Look at these profit margins. This is on strong revenue. When you've got the revenue increasing and the profit margins go from 1% to 23, 24%, that's how you create one of the biggest companies in the world.
Will any of the fundamentals indicate to exit the trade before the technical analysis will dictate so? It's a good question.
Usually not. For me at least. If you start seeing like real material earnings deceleration and the earnings report comes in, maybe this quarter is 10%, two couple quarters, the quarter before that was 50%, the quarter before that was 150. That's real big deceleration, but usually the stock price will pick that up either ahead of time or on that report. I have found that fundamentals do not do a very good job of giving you a heads up, or at least me. Maybe I'm just not, skilled or equipped to be able to identify, and I'm not in touch with the fundamentals deep enough to get that heads up. I'm sure there's someone out there that's maybe a lot smarter than me that can figure that out, but I haven't found it necessary. See, this is how I approach things in life and in trading. I try to figure out what's necessary. Okay, it's not a matter of, a lot of people do things just because, out of ego, because that's the way it's been done, out of tradition. What I try to figure out is what's necessary to get to my goal. Like, okay, you want to find a big winner. Why do you want to find a big winner? Okay, to make a lot of money. Well, what if I could tell you how to make the same amount of money finding little winners? I mean, would it matter? So is it really about money? So for me, it is. It's about it's not about the actual dollar amount, but it's about the percentage return. It's about getting the performance. Well, my goal is to get the performance one way or another. I want to get the performance, and I want to do it in the most efficient, quickest fashion with the least amount of risk, and only utilize what's necessary. Why would I do anything that's unnecessary? I want everything to be optimized to the point of everything that's unnecessary, all the fat is cut out of my system. I'm left with that nice fillet, that lean cut, that's all I want. So I'm always trying to figure out what's necessary. It hasn't been necessary for me to know the fundamentals to be able to nail down profits or know when stocks are topping to the point where I can, to manage my risk. I just haven't found it to be necessary. Everything that you see in this workbook and in my books and in this workshop is what I found to be necessary. This is what I found to be necessary, and what the only things that you need to focus on. I'm giving you 99.9% of everything that I do. There's that little fudge factor of my experience, of course, that's in there, that's big, of using all these tools. But you're getting it all. I mean, we're not hiding anything or keeping any secrets here. This is what I've done. This is how I've made, all my wealth in the stock market, and Mark Ritchie as well. And Mark Ritchie is simply a spinoff. I mean, he came to a master trader program just like you, and I didn't I didn't give Mark Ritchie any tutelage until he he did this all on his own, came to the master trader program, took the workbooks home, and it wasn't for years and years and years later before we did anything together. And for as far as him working for me, that's only been a couple of years. So a whole decade of him just reading the books, using this information, and practicing with it.
Continuing with this slide, how do you investigate company fundamentals? Do you usually get into reports, a company's internet site, Zacks, Benzinga, or just MarketSmith?
I have Zacks. I have an institutional service for Zacks that's like really expensive, and I barely use it at all. I don't have Benzinga. I don't have all. The only thing we have is we have some news services to just check earnings and mainly it's earnings reports. So the majority of everything I do is through MarketSmith. We confirm certain things when reports come out and news comes out. So it's just a news feed and MarketSmith and my my trading platform. That's really all I use.
Okay. Any of the biotechs recommended don't meet code 33 criteria. Sales, earnings, and margins just aren't there, but a promising drug. This is a member. Sharing most of my losses in the last few months have been from biotechs that I've taken positions in only to be stopped out. Is it best to stick with stocks with sales, earnings, and margins?
Well, you would eliminate a lot of biotechs or almost all biotechs. So I would say no. I wouldn't. I personally don't eliminate, and I'll let you answer that too, Mark. I don't eliminate stocks, biotechs with no earnings. Although Amgen was one of the few that had the earnings on the table back in the 1990s, which was great. But this recent setup in biotechs is a little bizarre because it looked like a really strong group. And I think what's happened is that it is a strong group. And I think the future for biotechs, there's a fundamental, I've made a very strong fundamental case because of COVID and what's developed. I think that we're going to realize that we need to put money into biotech research. And I think the future is very bright for biotechs, and it's going to be a leading group for some time to come. But we're in a bear market, and that's the problem. The problem is the underlying market. And that's what's created the volatility, which if you've been losing money in biotechs, it means you're probably controlling your risk and you're getting stopped out a lot. And that's what should happen in a bear market. If you think that the Nasdaq's going to be down 35%, and we're going to be in a bear market with interest rates hitting 40-year highs and being in a downtrend for the last 10 months, and you're going to be rip roaring making money in the market, well, you got another thing coming. You're only the very few, and you have to be short-term trading and being very nimble. So again, that's the nature of the beast here. We're in the bear market, and I think that's the problem more than anything. And again, the feedback, getting that feedback and saying, well, only one of a couple things could be wrong. If you're losing, the market's either bad or your criteria is no good. So look at your criteria and say, am I doing everything right? If you're doing everything right, well, then the market's bad, and you just got to wait it out.
And on that same level of questioning, do you look at debt, number of funds owning the company, or change in the number of funds owning the company?
I don't really, I'm aware of it. When I bring up a weekly chart in MarketSmith, it's right there. So you can see it. And I said I was going to let you respond to that too, Mark. So, yeah, let me I'll answer this real quick, and you can respond to both. How about that? How about that? I'm aware of it, and I would prefer, and I sort of relate it to the chart too. And you've got to backdate it a bit because that's delayed data, right? That's not up to date data. That data is between 3 and 6 months old. So I'll look at it, and usually what will happen is the stock's down big, the number of funds go down, and if it's up big, the number of funds go up. It just gives me, it's sort of like a PE ratio. Like it tells you, a PE ratio tells you the expectation. The number of funds tell me sort of how popular the stock is and whether it's over owned or not. So if there's 5,000, and I could tell you right now, almost every stock that has 3, 4, 5,000 funds in it, it's going to be Microsoft. It's going to be every one of the FANG stocks and all the biggest names and the Fortune 500 companies. Those are going to be the ones. So I would prefer, though, if I'm going to a really small stock, I'd like to see some sponsorship in there. I would like to see some funds owning it. If it's zero or only a few, then it's really, really quite thin. So it's really just going to give you sort of a ballpark idea. But am I trading on that? No, not at all.
Yeah, I'll just add, Mark, to the prior question is almost verbatim what you said. I would just add, though, that look, I've traded a lot of biotechs, and made a lot of good money trading them, most of which didn't have earnings. Some did, but that would greatly reduce at least the pie of winning trades I had in that area if I only traded them with earnings. And they're usually trading on the promise of future earnings. That's why. And then, in regards to the number of funds, that, and market smith even, that seems it lags quite a bit. So I would never use that for timing. And then ideally, though, if it's a situation that's set up, I think if sometimes, like maybe in the primary basis, those type of deals, I'd like to see some funds, but the idea, I don't want to see thousands. That tells me that's a lot of net sellers. Sometimes the best situations are those funds. Maybe it has 100 funds. It's a mid cap company. That still means there's a lot of firepower that could potentially come into the name. So that's kind of how I think about it.
I just want to point out a couple things. One, I think we're going to stop in a little bit here. I think we're going on 2.5 hours now.
Yep.
We're originally scheduled for 2 hours. We do have replays, and we want to make sure we respect people that are in other countries that need to see this at a certain time. So we got to replay everything. We're going to do another Q&A, of course. Right. When's the next Q&A?
Saturday.
Saturday.
After curriculum.
Okay. Saturday's another Q&A. So you have another opportunity. We've got many hundreds of questions. I don't even know if it's over 1,000 questions now, but hundreds and hundreds of questions. We obviously can't get to them all. So I apologize if we can't get to them all, but I know one thing, we will answer a lot of them as we go along. A lot of your questions that are asked will get answered just by default. For the curriculum is quite comprehensive, but we'll do another Q&A then, and then we have live trading on Monday, and we're open mic all day long through the whole trading day. And we're just really having just, discussion, and hopefully we're trading, or hopefully we're finding some stocks that meet this criteria, and we're putting live trades on. And then we'll have, of course, Scott Sinclair from Market Smith, IBD. We'll be going over all that. So you'll have an opportunity then also. So with that, let's go. We got another 5 minutes or so. Let's hit some more questions. Maybe you can move down the trough here, because I know we haven't gone too far down the slides here. We're still way early.
Yeah, basically on 108, Microsoft, in hindsight, in the case of Microsoft, every low would have been the best time to buy, not the new high. Most crucial was finding the right stock. Are there any other ways to find those great companies you mentioned? You missed a lot of those big moves of Yahoo. Would it not be better to stay with some great names and trade those in and out versus always trying to find new names?
Well, I don't know what your comment about the low is. I mean, in hindsight, obviously we can look at the lowest price and always determine where it was, but we don't get the benefit of hindsight in real time.
Where was the low when it's going down through a 20% correction? Was it at 1%, 2%?
I mean, you can look at Facebook right now. It went down 75%. Which low is the real low? I mean, if I'm sure a lot of people thought the first 20% decline was the low, and then the next 10% was where the real lows. Please stand up. So, but the question is, the answer is that you want to be trading coming out of the consolidations, and I think the whole concept of time versus value. When you see all these black dots, you are gaining value. When you are in the no black dots, you are losing time or losing value, one or the other. If you peg the absolute low, you would have gained value from there. Okay, I don't know. I haven't figured out how to do that. If you figure that out, let me know. We'll do your clinic next. The other thing too is that, again, with time value, yes, you can be trading in and out, but you want to be trading in and out, like I said, when you're getting that move. And where's the other slide? This is making my point. So even if you did peg the low, let's see the stock's down 50%, or even if it's down 90%, it goes up 900%. Well, that's your first 900%. Let's say you peg the low on Amazon and you get it from the low to its all-time high, and now you sell it at its all-time high. You made 900%. That's great. That's if you were clairvoyant to be able to pick the exact low, hold it through the whole 900%, and sell it when it hits an all-time high. Well, that was only the very tip of the iceberg. Amazon went up 80,000%. The big move happens in the black dots. That's where the big move, it has to. It can't happen any other way. If a stock goes down 50%, you have a big correction in the stock, 50%. If you peg the absolute low and now you're afraid of the new highs, right? Just say the opposite. You don't buy at new highs. You sell at new highs. Well, your upside's 100%. Well, if you did that here with Yahoo, even if you got 170%, well, you gave up 4,300%. I'd rather be buying here at new high ground and having this big move, and I want to be in the black dots. I'm not trying to buy. And again, there's no way to know where the low is. That's the other thing. You're taking that risk of it going lower and lower and lower, and you still have to manage the risk. So that's we went through this already, but I'm happy to recap.
All right, on page 112. We currently have a lot of cyclicals and other stocks that made predictive breakouts and high RS and generally uptrending. How can we discern defensive rotation, institutional hiding in defensive names from new leadership? The defensive names are less likely to lead when we get back to an easy dollar green stem model reading. And was Walmart in 1982 a defensive stock or a revolution in retailing?
No, it was a high growing, smaller mid cap company that had a cookie cutter concept that was scalable and could be secular because they can stamp those out. There wasn't a Walmart everywhere. There was very few. So no, that's a classic cookie cutter concept, which in my first book, you should read about the cookie cutter concept, because those are the type of names that if you're going to hold for big moves, that's what you want. Those are those scalable that they can duplicate it. So your question is, how defensive leadership. Well, again, we've got inflation took off and you've got interest rates moving up. So you can see, the oil and oil stocks are moving up. War, the catalyst, that's not, that is leadership right now. That is leadership. That's not just money moving in defensively. Defensive is the food stocks. You moving into some of these food names and utilities and things like that are clearly defensive. So could you get the oils to lead? Yeah, they're leading right now. But again, I don't really understand, what the point is. The point is that if you just trade the stocks that are setting up, breaking out of bases, you're going to be in the leadership. And my point is that you don't have to wait for the market to make it necessarily a low. The market could be in a bear market. And if the stocks are meeting the criteria, the leaders will set up sometimes before the market makes its final low. So once the market's in a correction, as you start turning up off those lows and you maybe get an O'Neill follow-through day, that's where you start trading into the stocks and you give them the benefit of the doubt, the ones that are breaking out, and you may go to another low. Now from there, you have to assess the ones that broke out prior to going to that lower low. Are they still holding up? If they're just pulling back to their breakout levels and you got more stocks setting up and the next upturn, you should be buying more names, because that's telling you that the original leaders are holding up, and now you're going to get maybe some coincident moves. And it might even be, again, we showed some examples where you had 3 pushes down and something like Apple. Apple broke out and there was several pushes to lower lows in the market and it just made higher highs. So it's just a reference point to be able to measure against, as opposed to having some magic, period that you're necessarily going to know exactly when to buy.
Do you know the percentage of times or the leading stocks will be in the predictive versus coincident versus confirming category?
I could tell you this, as far as them bottoming, and actually bottoming first and getting into a stage 2 uptrend prior to the market in a bear market will be like 90%, 95% of the time. The leaders will bottom first. So they'll make their low and they'll turn into an uptrend before the market makes its low and turns into an uptrend. As far as breaking out of bases from a predictive, a coincident, or confirming, that changes. It's just a dynamic, a moving target that, no, I can't say, because there's not even enough data points to even say it would be statistically significant. How many bear markets are there? In my career, I think I've been through 9 bear markets. So that's not exactly, scientifically significant number of data points.
I think, though, I've heard, Mark, either from you, maybe David Ryan, but I think I've heard before 2/3 of the time it is predictive or coincident, but that may be a stat that I just
I
grabbed
would,
out of.
I would say from my own experience, you're moving up. It's I would say it's 1/3 across the board, and I would say that it leans to 2/3 being coincident to confirming and 1/3 predictive. That would be my guess, or what more my own anecdotal evidence. But I would say it's there's a little of every. There are going to be some predictive, some coincident, some confirming, and then there's going to be setups that happen way after the market's been up for a year, 2 years, and they're still playable. As a matter of fact, you go back, you look at like someone like Nicholas Darvis, he basically had a trend template. His trend template was that until the indexes were up for 6 months, he didn't buy. It was just a very basic way of making sure that the market was healthy first before he bought. So again, he didn't want the lowest price. He wanted the right price. So we hear these questions about picking the low. That's when I know you've got a lot to learn, and you've got a lot of trouble ahead that you've got to go through before you learn the lesson of trying to pick lows. The greatest traders, picking lows is not where the money's made. Bottom picking, trends are where the money's made.
And the last question on this slide is from somebody else. How does it help them to know what the difference is how does it help them in their trading, knowing if the leaders are being productive, coincident, or confirming?
It doesn't. And I mean, it's not going to help in the current moment, except that like I said, it tells you that when you are in a bear market and you start turning up from the bear market, you're going to probably buy some stocks that they set up, right? You get a follow through day, stock set up. Now you go to lower lows. Well, you doesn't mean that you just dump your stocks because the index went to a lower lows. You see these headlines, everybody starts panicking. If your stocks are holding their stops and more stocks start setting up, well, now in hindsight, those were predictive. So that's telling you that you may be on a key leader. So it's very important as it's happening. It's not like it's going to tell you ahead of time what to do, but as it's happening, it acts as a roadmap to tell you where you've been and now where you may go. Because now that you've gone through another lower low in the market, that stock that's holding up was now, it was predictive. Well, that means it's strong. That's the characteristic of a leader. So I might not sell that stock now so easily. That's a stock I may want to hold, or maybe it sets up another base, and now off the coincident low, it breaks out of another base or another pivot point. It came off the low cheap off, and now market goes to a lower low. During that lower low, it sets up a handle, and now market turns up from there. And on the day we have a follow through day, it breaks out of that handle. I'm adding to that position. That's telling me that I may be onto something really big here. So that's how it helps you as you're going through the process. This is all about reading the signs and the guidepost. And this is you're managing your position. This is always a moving target. It's very dynamic and it's always changing. And you've got to be able to understand where you are from a reference point and then what it means. And these are all things that help you understand where you are, where you are within the cycle. I don't know if that makes sense. I don't know, Mark, this is getting into a very sort of esoteric and somewhat subjective area, but do you have anything to add to help?
Yeah, I would just add, Yeah, I would just add maybe more for, interest that I've found personally. I think I probably made the most money in that confirming area,
Absolutely.
because that's where you can really get aggressive, So, and often I'm dipping a toe in some of those predictive ones because or even coincident because I'm not sure. Again, I'm not interested in picking bottoms, and then it's, it could be the same name you already own, or then a whole nother wave of setups happens in that confirming. It's usually both. Usually some of the best names set up subsequent buy points in that confirming period, and then you see a raft of new ideas, and that's where you stomp on the gas.
Yeah, I would say the same thing in the confirming area. Once the stock, the market's in an uptrend, that's where I've almost always made the bulk of my return.
All right, so I think we'll have our session end here at this point. It's a good break point for us, and that's a great slide and good answers to that for the last 2.5 hours. As a reminder, guys, we will be having the replay tonight, just actually a few hours from now, but 6 p.m. Eastern time, we'll open up the room 30 minutes beforehand. As far as the questions, like Mark mentioned, we do have 2 additional question and answer sessions already scheduled, so we will have more time to get through them. Plus, a lot more is to be taught in the curriculum, which will answer a number of questions that I know have also been submitted as well. With that said, I'll thank you, Mark and Mark. Perfect time to go watch the rest of the football games. My Eagles don't play till tomorrow night, so we couldn't have scheduled this any better for me. And watch my 8-0 Eagles go continue undefeated.
And so we
Anyway.
give you the week here to sort of digest everything and go over it. And then next week you'll have questions and we'll continue, but it's going to get even deeper. The risk management side is going to get pretty deep, where that's sort of where I think we save the best for last. And then mind-blowing math is a section where I assure you will really have light bulbs go off, and it will be quite enlightening. So there's still a lot to go. And then we have, of course, live trading, and that's where we put it all together, and go over the screening and have even more fun. So again, it's going to be a lot more to go here. We've only gotten I don't know, 35-40% through it here. So we'll see you next week, and enjoy the week and try to go over this stuff and digest it and make heads or tails of it. And then of course we'll see you on Saturday.
All right. Well, with that said, I will we'll all see you in just a little while. So get some rest. I know I need a little bit of to lie down, and we will reconvene very shortly.
And
Thanks.
there's a replay of all this tonight, of course.
Yeah. All right. Same login information, same credentials as always, guys.
6 o'clock. Is it 6 o'clock on
6 p.m. Eastern
time? Okay.
Room will be open 30 minutes before.
Okay. See you guys.
Recording
Mark, thank you.
stopped.
Bob, thank you.
Take care, guys.
Bye-bye.